the consumer is not as resilient as they've been in the past. They're more sensitive to prices.
Stagflation really induces and is a precondition for a growth recession.
You've also got this fact that the world is changing. Economic volatility is so much higher now.
The market has shifted completely away from inflation concerns towards recession concerns.
For most people, it looks and feels like a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Tom hasn't been this excited for weeks. It's Fed Day.
It's
Live
Fed Day.
from New York City for our
Yes.
audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. TK futures up 1%. The Fed decides just around the corner.
Yesterday was nuts, and today is nutsier. I can't convey, John, the frenzy that you see on the Bloomberg terminal screen. There are so many stories to tie in here, and what it means is I believe it's at 2:30. Chairman Powell's going to do one thing. He's going to try to maintain control of the dialogue.
Expected to raise rates 75 basis points. TK, what are you looking for just in terms of the guidance into September?
I love what Krishna Guha over at Evercore ISI with Julian Emanuel says. Are we going to see a Volckerized Powell? And this is really interesting, John. Is he going to give us a hawkish tilt? And I'm wondering if he will surprise and walk a bit away from that.
I have to say, Lisa, September feels like a long, long time away at this point.
Especially because the data is moving so quickly and these earnings have proved to be really inconsistent, not actually showing a real picture that goes one way or another, right? Some have been disappointing, some have been not the worst case scenario. How much does the Fed chair recognize some of the negative data that we've seen? How much does he give a nod to that versus say inflation is still our number one concern, even with job cuts, even with the idea that we face softening growth?
So we talk about the data point that is Google ad revenue. That was a sigh of relief, wasn't it?
Yes.
Everything
Yes.
I've read has just got the R word. Resilience, not recession. Resilience, Bramo. That was true of Microsoft and Google yesterday.
And that seems to be the theme, even though they do speak about caution, about ratcheting back hiring expectations, even though they both missed on a number of different items, both came out with projections that really defied some of the worst case
John,
expectations.
I was fired up on this yesterday afternoon. I was really upset about the gloom coverage on this. To me, they're doing fine. And the question is, John, what do you do with foreign exchange adjustments? Strong dollar. Guess what? It affects earnings of U.S. multinationals. Guess what? So what?
You know why
move
there's
on.
gloom, though, Tom? There's more than just FX. You go through the Microsoft press release. Read it. It's about unfavorable foreign exchange. Then it's about extended production shutdowns in China, reductions in advertising spend, the ongoing war in Ukraine, issues with Russia. Take your pick. There are many issues there, Tom, that have yet to be resolved.
And the Red Sox are in last place. I mean, there's many issues out there, John, but, more than anything, I would say life goes on. These corporations are going to adjust. And you saw that yesterday. The stocks go down, OMG, crises.
And they bounced.
And then they come back. Get over it and move on.
Bramo's Mets beat the Yankees.
Yeah,
Aren't we going to be talking about that?
Perhaps.
It's
I
fun.
will say, though, that there is this feeling to me that perhaps some of the bad news has been baked in. If even though, John, to your point, all of those warning signs, and even though you could have found pessimism, the stocks rallied, what does that say about what's been baked into the market?
This is really important. The middle class is flat on their back. The president will address that. We heard from former President Trump yesterday. Louis Vuitton came out with earnings. You know what? Basically, they're killing it.
Louis Vuitton, Tom. But you knew that anyway. I don't know what you're up to, but you knew that anyway. Futures positive 0.9% on the S&P 500. On the Nasdaq 100 up by 1.4%. A sigh of relief from Google and we're off to the races. Yields just a little bit lower by a couple of basis points. You're going to be troubled today, aren't you?
Yeah.
I know you are. Euro dollar 101.42.
Extended trouble.
Slightly stronger euro in the mix here, Lisa. Euro dollar positive 0.2%.
Yeah, well, today, obviously, the main event is that 2 p.m. FOMC rate decision, followed by the 2:30 p.m. press conference with Fed Chair Jay Powell. We're going to be, of course, having the Fed Decides show, which I believe Tom learned about yesterday. Guests include Mohamed El-Arian, former PIMCO Chief Executive Officer and Bloomberg Opinion, as well as Bloomberg Opinion columnist Bill Dudley and former New York Fed President, and Diane Swank of KPMG, the chief economist there. How much do we get a sense of what the Fed needs to see to back away? Is it weaker jobs numbers? Is it weaker just general data? Because we're already getting that. So does that concern them, or are they still full steam ahead? Earnings continue. Qualcomm, Meta, and Ford Motor after the bell. All of that coming out to give us a sense of whether perhaps what we saw of Alphabet and Microsoft, the sigh of relief, can continue. Right now, those shares are doing better, but throughout the year, they have been absolutely eviscerated. Qualcomm down 18%, Meta, Facebook, down 53%, and Ford down 40%. And also, we get a slew of economic data. And John, I'm actually particularly interested in the housing data, because what we have seen consistently is a real dramatic weakening there, especially with the sales data that we got yesterday in terms of new home sales plunging to the lowest in 2 years. Do we get an ongoing feeling of that with pending home sales, which come out at 10?
That's the goal of monetary policy, isn't it, Lisa? Isn't that the objective?
Okay, but how quickly is this moving? It's moving so quickly that some people are estimating that you could see 15 to 20% price drops in a number of different regions that haven't been recognized yet. At what point does that bleed into consumer confidence that has a whipsaw effect that perhaps comes quickly rather than all at once, rather than slowly as the Fed tightens?
John, she can't go away. I mean, Kaylee just can't do the gloom like Lisa. I mean, it's just, that was outstanding.
I'll take a price drop here in New York any day. Whenever they're ready.
Yeah,
I'm not sure that's coming, Tom.
No, seriously, John, what was really important is in the building permits, whatever, multifamily exploded higher versus single family. That ratio is really, really interesting, and it really signals it's going to be a renter's 2023.
Joining us now is Phil Orlando, the Chief Equity Market Strategist at Federated Hermes. Phil, let's just start with the Fed a little bit later. What are you looking for?
75 basis points today. You talked about the importance of the presser at 2:30. Well, I would agree that is important. We're actually looking at Jackson Hole in exactly a month, August 26th, because what that meeting does is it provides another look at the inflation data, particularly this 9.1% nominal CPI number, which is sitting at a 41-year high. By the time we get to Jackson Hole, the Fed will have seen the July inflation data. And that, I think, will provide us with better guidance in terms of what's going to happen at the September 21st FOMC meeting and then the November and December meetings to follow. So does the Fed stay, uber aggressive here in terms of withdrawing accommodation, or do they start to downshift to something a little easier? And that's still right now, I think, a very much open question.
Phil Orlando, good morning to you. I was doing Wall Street Week for David Weston the other day, and I noticed a handsome Phil Orlando with Lou out about 1997. The bottom line amid our daily gloom is stocks for long term. The Dow was 7,500 in 1997, and we're enjoying a Dow today at 32,000, plus or minus a given bit of gloom. And the answer is there's really no other story, is there?
So stocks historically go up and to the right because the U.S. economy, we're the greatest economy in the world. Corporate earnings are positive, and stocks ultimately reflect corporate earnings. So the longer-term story, in our view, is still constructive, still positive. But we thought that 2022 was going to be a difficult year because of inflation, Fed policy, decline in earnings, decline in price-earnings ratios, and so far that's playing out in spades, and we think there's a little more to that over the course of the next couple of months.
Phil, what we've seen so far from the earnings has been resilience. We were just talking about that. But if you take a look at the overall averages, it really hasn't been that great. The number of beats is lower than expected, at least lower than historically. How much do you get a positive signal from the earnings we've seen so far?
I'm actually disappointed in earnings, Lisa. Welcome back, by the way.
Thank you.
I guess we were expecting sort of a 4.5% year-on-year number. We're 31% of the way through the earnings season. Earnings are down 3.5% so far. You look at the downward guidance that Walmart gave us yesterday, consistent with the downward guidance that Target gave us a month ago. The trends that companies are talking about, too much inventory, sales are slowing, margins are shrinking, labor costs up, commodity costs up, transportation costs up. Worker productivity hasn't been this bad in something like 70 or 80 years. So the near-term trends are not good. Third quarter likely to be worse. So we're struggling right now, and stocks are trying to sort of reprice themselves based upon what should be lower economic growth and lower corporate earnings estimates.
Phil, that was a disappointing finish, I have to say. Phil Orlando.
Sorry, John. Thank you.
Phil, thank you, buddy. I'm disappointed. Welcome back, Bramo. Those two things seem to go hand in hand, don't they?
Well, yeah, the bears seem to gravitate toward me, whereas
you were Miss
people who are
Bremo,
super
you know
bullish.
you were. Looking at Alphabet this morning, the stock's up by 3.7% in the pre-market. Looking
Really,
at
that
Microsoft,
much? I didn't know that.
we're up by 3.8% this morning. As Lisa indicated, Tom, we'll get Facebook a little bit later. Then on to tomorrow, we'll get Amazon and Apple.
As you know, John, there's a brass plaque on the ground in front of the Liverpool station in London, lovely London, near the old Great Eastern Hotel. And outside it is where John Ferro and I stood at line to go to the McDonald's at Liverpool Station. The BBC, just in, John, McDonald's puts up the price of a cheeseburger in London for the first time in 14 years. This will be a more expensive lunch than it was for us years ago.
Would you like to share with the audience what time that visit to McDonald's was? Or should we give that a miss?
I think we should.
This was the front page of the FT this morning as well, Tom, in the Financial Times. The world's biggest consumer names announced soaring price increases. We saw that across a few companies yesterday.
Again, it's a discrimination of individual stocks, and as I suggested yesterday, individual sectors. That's why it's so timely to talk to Chada today from Deutsche Bank.
Looking forward to catching up with Binky a little bit later. Lisa, you talked about that yesterday too. This has been a thing for the last year or so. Where's your pricing power? Who's got the pricing power?
Yeah, and I'm wondering whether the types of names that we're hearing that have pricing power are indicative of where we are in the cycle. It's Coca-Cola, it's McDonald's, it's Chipotle, it's the lower cost fast food types of places, not necessarily the higher cost places. So how much are people just sort of ratcheting down in terms of how much they're spending and going more to some of these other places, giving them greater pricing power? I know this sounds a little bit derivative, but this is something a lot of people are talking about.
Something they're following. Futures positive this morning, up 0.9%. Good morning to you all. If you're not enjoying this, I'm sorry. You've got 10 more hours of it going into a Fed decision and out the other side.
Who are you talking to, the audience or us?
To my mum, looking for help, some assistance, some support. Futures up 0.9% on the S&P. Yields come in a couple of basis points, 278.49 from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The Federal Reserve is expected to raise interest rates by another 75 basis points today. Traders will take a close look at the language of the Fed statement to see what it thinks of the path ahead. The central bank is likely to acknowledge there has been recent signs the economy is weakening. Now, Credit Suisse has tapped veteran banker Ulrich Körner to be its new chief executive officer. He will succeed Thomas Gottstein, who's resigning after 2 years marked by scandal and huge losses. Meanwhile, the Swiss bank will conduct a strategic review.
We are going to refocus our investment bank into a highly competitive banking business and a much better aligned markets business. This is work under progress, and we will report to the market with the third quarter result.
Credit Suisse posted a larger than expected second quarter loss of more than $1.6 billion. President Joe Biden will speak with China's Xi Jinping tomorrow. The call will take place at a difficult juncture for U.S.-China relations. House Speaker Nancy Pelosi's staff has not ruled out that she'll visit Taiwan next month. China has warned against a trip. Beijing considers Taiwan part of its territory. And for the second night in a row, the two Conservative candidates to succeed the British Prime Minister Boris Johnson battled it out in a televised debate. Foreign Secretary Liz Truss and former Chancellor Rishi Sunak clashed again over the economy. Both accused each other of pursuing policies that were morally wrong. The debate was cut short when the presenter Kate McCann fainted. The event organizer says she's now doing fine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
We see that there is a divergence in the economy right now between sentiment and spending behavior. We are motivated to try to bring prices down exactly because it's hitting families. Bringing gas prices down is an important part of trying to bring some relief economically and also in terms of consumers' outlook.
The administration tied itself in knots ahead of the GDP report coming up on Thursday. Brian Deese there, the National Economic Council Director from New York City this morning. Good morning. Tom Keene, Lisa Abramowicz, Jonathan Ferro going into a Fed decision with futures up 0.9% on the S&P. The Nasdaq doing nicely off the back of the earnings of Microsoft and Alphabet. Nasdaq 100 futures up by 1.4%. Yields in a couple of basis points on a 10-year, Tom, 278.49. And for once, no drama in euro dollar, 101.44. Up by about a third of 1%.
Yeah, but with that, I would still watch currency, John. Euro Swissy is really what I'm focused on with a 0.97 handle. That's stronger Swiss franc. It's really, it's just a really interesting currency.
I'm with you, Tom. I mean, the story's not over for Europe by any stretch. I think it was Goldman out in the last 24 hours who basically said recession this year in Europe. I think that's going to become base case pretty quickly.
There is a photograph of Dwight David Eisenhower walking with Chiang Kai-shek of Taiwan, and it is a diplomatic Eisenhower trying to traipse through it. Nelson Rockefeller, as vice president, attended Chiang Kai-shek's funeral, and I believe in the middle 70s. But far more, it was a moment that my grandparents talked about in 1943, where Mrs. Chiang Kai-shek spoke before Congress. It was a statement on the independence of Formosa and Taiwan. Anne-Marie Horton joins us now, our Bloomberg Washington correspondent, on a minor affair, which I don't think is minor, Anne-Marie. The Speaker of the House, am I correct, will visit Taiwan?
Well, you're not correct in the sense that we don't have a firm confirmation that she will make that stop to Taiwan. But yeah, she is planning a trip to Asia in early August. What we do know overnight from Kyodo News is that she's already making her preparations to stop over in Japan. But they'll talk about security concerns. There hasn't been an announcement yet on this Taiwan trip. But it does seem that that is the direction of travel. She was supposed to go in April. Then, of course, she got COVID, so she had to stay behind. But now it's become a really difficult moment for the administration. The president was very direct, saying the military says it's not a good time to visit Taiwan. But now she's almost being pushed to go by her Republican colleagues. Even Kevin McCarthy is saying we should make it a bipartisan trip. But at the same time, China is saying that they strongly are against this and they are making preparations for it.
Is this ad hoc? Is it her alone planning this trip?
Well, we don't know exactly who should be traveling with, but yeah, she would be the most senior member going, and it's a Speaker Pelosi trip to Asia.
Anne-Marie, how does this set up the call with the President of the United States and Xi tomorrow? How's this going to go?
It's a lot of tension right now between Washington and Beijing. This is obviously something that is going to irk Xi Jinping. I mean, we discussed it on this program. I think sometimes what gets lost in American media is what's actually going on in China. There could be a lot of deflection here about this trip, about Taiwan, about the Taiwanese Strait, because of the pressure Xi Jinping is under at home. Look at the news this morning out of China. There's a district off of Wuhan, 1 million people locked down again. They have not moved on from March 2020, and the rest of the world has, and it is crippling their economy. Individuals coming out of college have very limited job prospects. There's a lot of pressure on Xi Jinping, but this does set up a lot of tension for this call on Thursday. The president has been foreshadowing it. Our Jenny Leonard put a date on it. It is happening tomorrow. And of course, the other big topic is going to be tariffs. Right. That's something that Xi Jinping really wants to be lifted.
And Anne-Marie, that's where I wanted to go. How do we dovetail a hardline message that Nancy Pelosi is trying to send with rolling back tariffs from the Trump era, which is what the proposal is currently from this White House?
Well, we just don't know yet if they're going to roll back those tariffs. They've been debating it now for months, and there's a number of factors at play as the president tries to make this decision. One, of course, they said they're going to use any tool in the toolbox to bring down inflation. So economists say, let's get rid of some of these tariffs. The second, of course, is his national security team. You have those in the trade world that say we should not be giving China an inch. Also, you take away some leverage. And then, of course, the third is the unions, the labor unions. They do not want tariffs lifted on China. And this is a president who talks about and constantly goes and speaks to labor unions. So it's a difficult moment for them to decide on what to do with these tariffs, but it's something Xi Jinping certainly wants to see out of Washington.
Mate, let me squeeze this in. Are we going to hear from Secretary Yellen tomorrow after GDP?
We will. Yeah, she's going to give a press conference to the GDP. I imagine she is going to explain what a recession is to the American people, because yesterday Brian Deese said that 2 back-to-back quarters of consecutive negative growth is not a technical recession. So I'd like to hear what Treasury Secretary has to say for that definition.
Looking forward to it. AMH, thank you. Looking forward to catching up with Andrew Hollenhorst of Citi. Lisa throwing her hands up in the air about this. They really are tying themselves in knots around a print that might actually be positive tomorrow morning.
And they're tying themselves in knots repeatedly, trying new lines, because Janet Yellen was on all the talk shows over the weekend saying the same thing. Brian Deese has been coming out with the same messages again and again. How do you define recession? It's not just a technical kind of definition. It is something else, and we can pinpoint what it is. It isn't working. The R word is still very much prevalent in people's psyches, and so are some of the inflationary inputs that we're seeing that are bringing down consumer confidence.
John, our survey's a positive statistic.
It is a positive statistic. There are a range of banks, a number of banks who think we get a negative print, but the median estimate is a positive.
How come when I throw my
point.
hands up, you don't say anything?
Well, I can't see you.
The Bramo cam?
Lisa's more emphatic about throwing her hands up. How often do you throw your hands up?
I just hit the mic.
I'm aware,
That's the
Tom.
reason
It made
why you don't.
a massive noise. Are you apologising to?
Roman.
A Roman.
Roman,
Okay,
sorry.
that's helpful. Anything else to add here?
No, I'm really looking forward to Andrew Hollenhorst, folks, on Global
Good.
Wall Street. This is must listen. After Anna Wong of Bloomberg Economics out Hollenhorst yesterday with a 5% terminal rate. John, that was stunning.
Andrew's at 4% year end. He's
Yeah.
looking for 75 basis points a little bit later. He had changed that to 100, then flipped it back to 75. Futures right now up 0.8% on the S&P 500, on the Nasdaq 100 up by 1.4%. I have to say the earnings better than expected when it came to Alphabet. Google ad revenue.
Everybody.
Resilient, Tom.
At least
resilient.
we're not conflating it with Shop or Shopify.
If you were looking for some resilience and defensiveness from the likes of Microsoft and Alphabet in a moment like this one, I think that's what you got from those numbers yesterday, which maybe gave you a little bit more confidence.
I mean,
for now at least.
I mean, Microsoft, they're struggling. Their free cash flow is modeled right now this year. It's $67 billion. They're struggling.
I knew you'd be on a rant about this today. I knew that.
They're just struggling. Apple's going to struggle
He
whenever
loves
that
cash,
is.
Bramo,
tomorrow.
you're right.
Triple
Does love-
leveraged.
he's all about
Free
it.
cash flow.
It is Fed Decision Day from New York. This is Bloomberg. So far, so good this morning. Good morning. Futures higher on the S&P.
We're still
Up
speaking.
0.8
It's
of
great.
1%. Just about. I was characterising our relationship so far this morning, Tom. So far, so good. The Nasdaq 100 up by 1.4%. Two names you need to know, Microsoft and Alphabet. So far, so good. They look pretty decent. Resilient. Resilience seems to be the word I keep hearing again and again. The stock's up 3.6% on Alphabet, on Microsoft up by 3.85. Looking at yields have come in since this Fed met. They've come in a lot. Your 2 years back to 3%, your 10-year sub 280 at 279. And Tom, you've got to remember this equity market bottomed the day after the last Fed meeting. And since then, we've picked up speed. Bill Ackman out on Twitter in the last day said this. I think this is important. The more the market believes that the Fed will immediately reverse course, the less effective raising rates will be in moderating inflation, and the more the Fed will have to raise interest rates. I wonder what that means for communication from this chairman a little bit later in this news conference.
It will be interesting. We're going to dive into it now and start our Fed coverage right now. We do this with someone that has led the dialogue. Andrew Hollenhorst, chief U.S. economist at Citigroup, has really been out front on saying this Fed is behind. Let's go, let's go, let's go. Andrew, Claudia saw him this morning in the Financial Times with an absolute tour de force on what she calls the Philip cloud. The math is bad. The Phillips curve doesn't work. Standard UCLA economics doesn't work. Less than 1/3 of monthly core inflation, which excludes food and energy, is due to demand. This is all supply side. There is no increase in the unemployment rate that would produce microchips for new cars, end China's lockdowns, defeat Vladimir Putin, drill oil, and build apartments. Andrew Hollenhorst, why do we need to raise the unemployment rate?
I think it's a very difficult situation for the Fed, a very difficult situation for the economy here. And, you know, it may be true that a lot of what has gone on with inflation is due to issues on the supply side, but it's always supply and demand together. And I would say that's the UCLA economics, is that those two forces work together. And we have demand that is outstripping the supply side. So if you can't create more semiconductors, if you can't build more autos, the only way to bring down prices or to not have prices continue to increase is to damp demand. So it's an unfortunate outcome. It's not an outcome I think anybody is pleased that we're dealing with now.
Right.
But that is the situation, and that's standard macroeconomics. So I'm very surprised to see economists coming out and saying that there's nothing that the Fed can do. We know exactly what the Fed can do, which is to raise interest rates and damp demand.
If we get to a Hollenhorst 4%, or Bloomberg Economics' Andrea Wong with a stunning essay yesterday migrating up to 5%, what does that do to the inflation rate? Does that drive us back to John Taylor's 2%? John Taylor's at a school, Andrew, north of Los Angeles. I don't know if you're aware of that, but does it get us back to a Taylor 2%, or does it get us halfway back?
I'm vaguely aware of that school. I have some family members who attended there. So, but no, what the issue here is that you get interest rates higher, you tighten financial conditions, you slow down the economy, and then you see how powerful that Phillips curve relationship is. And that's what we really don't have a good sense of. So there, I would really agree with the idea that the Phillips curve does not function the way that it used to. We had a very flat Phillips curve, at least up until the pandemic period. If that Phillips curve still proves to be relatively flat, it could be hard to bring inflation back down to 2%. I'm hoping that it's a little bit steeper where we are right now, but that's really something we have to find out.
John, that's in cap. We need this as a video for this afternoon when we come back. Get one of the interns on it. Get the intern from UCLA to make the video of what he just said. John, that's the heart of the matter.
So, Andrew, let's get to the heart of the matter in this news conference. How is Chairman Powell going to navigate some of this stuff? And to Lisa's point a little bit earlier in the program, we've been asking this question. How do you expect him to acknowledge some of the weaker data points we've already seen?
What a tough job for Chair Powell this morning or this afternoon. Tomorrow, we may get Q2 GDP that we think it'll be slightly positive, but it could be negative. So we could have 2 quarters of negative growth. And then on Friday, we're going to get the employment cost index, which will probably show very strong wage pressure. So you have an inflation situation that, at least in our view, looks more persistent, looks more problematic, and you have growth that's slowing. It goes back to what we were talking about initially, and it goes back to what Chair Powell was talking about at the June FOMC, which is that it is painful to bring inflation down once you have too high inflation. I don't think that he's going to completely stick to that hawkish message from June, like you were mentioning in the market pricing. Maybe the peak hawkishness in terms of perceptions was in June. I think there does need to be, or there will be, some acknowledgement of the weaker data. That could sound a little bit dovish at this meeting, but I would look at that more as a dovish detour still on the way to a hawkish destination.
Well, let's talk about that dovish detour. Do you think that the easing of financial conditions over the last month or so will become problematic?
I think that's what the Fed is trying to figure out now. We had a very swift tightening of financial conditions. And really, it takes months, if not quarters, for these financial conditions to kind of work their way into the economy, slow down demand, and then eventually affect inflation. So the idea that you're going to see financial conditions tighten and in the next monthly inflation report see some kind of effect, I think that's really fanciful thinking. So if financial conditions have eased a little bit now, but they tightened significantly before, again, it's a reason for the Fed to maybe take a breather at this meeting and not push further in the hawkish direction. I think eventually they'll need to, but I don't know that they'll be particularly concerned that financial conditions have eased in some ways since the last meeting.
Andrew, it's so difficult for a Fed at a time when no one can predict the future and economists are very split on where things are going. So perhaps it's more instructive to understand the parameters of risk, which risks the Fed views as the most likely. Is the risk of them tightening too quickly now and having to cut rates bigger or smaller than slowly and steadily raising rates? This seems to be underpinning a big debate that the market has weighed in on, basically saying that they're going to cut rates next year and it will be net beneficial for markets.
Right. So I think that is what markets are starting to price, is that the Fed will have some kind of a pivot. And I don't think that we're going to see that pivot from this Fed. Really, we have to hear more about the Fed's reaction function, exactly how they plan to address too high inflation. If I take Chair Powell seriously, the rhetoric at the June FOMC was that inflation is the number one issue this Fed is trying to address, and that Powell is willing to do the difficult things like a former Chair Volcker did to bring inflation down. And it really is that commitment to bringing inflation down that does bring it down. If the market starts pricing, and I think it's beginning to, that this is a Fed that's not committed to bringing down inflation, that this is a Fed that's going to pivot to more dovish policy before you've brought inflation down, That's a real issue for the Fed. So they do need to get ahead of that at some point. Do they do that at this meeting? Do they wait until Jackson Hole or September meeting? I think that's where the kind of tactics come in. But in terms of the longer term strategy, there has to be that commitment to fighting inflation.
Andrew, this is hinged on the belief that seems to be the consensus right now in markets that the bigger risk is the Fed not raising rates quickly enough and allowing inflation expectations to become unhinged. Julian Emanuel yesterday of Evercore came out and said it's actually the opposite that is the bigger risk, that if the Fed raises too quickly now and then has to cut next year, that is the key that will cause inflation expectations to become unmoored. Why do you disagree?
So I think that the risk that the Fed is facing is not hiking fast enough. If you don't hike fast enough, then you get higher inflation that becomes embedded in the economy, and it becomes that much more difficult to bring it back down. And you may need an even higher unemployment rate to bring it back down. So if you're a Fed who cares about inflation or cares about unemployment, the right thing to do is to address inflation head on. This is the lesson of the 1970s. In the 1970s, we had various scenarios where Fed officials thought that the economy had slowed down enough. They took their foot off of the gas pedal, or maybe we would say the brake in terms of the economy. And then you saw inflation pick up again and become more and more embedded in the economy. So that's exactly the scenario that I think this Fed is trying to avoid.
Andrew, just quickly, is this the final 75 basis point hike of this cycle?
I don't think so. I think we're going to see strong enough inflation between now and September for them to go 75 again in September.
Wow.
If you kind of look at where the Fed wants to get to, I think it's still significantly higher from here. So another 75 wouldn't surprise me.
Interesting. Andrew, awesome to catch up, buddy. As always, Andrew Hollenhorst, the City. That September call, that's where the tension is right now for September. Ian Shepherdson at Pantheon, good friend of this program, good friend of ours.
Yes, friend.
Said this coming into today. The Fed is boxed into a 75 basis point hike. The latest inflation data likely will keep the talk hawkish. Things will change by September, Tom, he says. But Chair Powell can't claim victory yet after the transitory debacle.
That was brilliant with Andrew. And, I'm going to go to Ed Yardeni, who I thought was brilliant. And Ed Yardeni's a very different Yale economist from what we got from Claudia Sahm from Michigan. But, John, the Sahm-Yardeni attachment here, that, they're going to raise rates, and then what? And both of them are saying they're restricted from crushing this economy in their own ways.
Well, Tom, do you think there's a little bit of politics baked into some of the analysis?
Always. There always is.
I think Senator Warren was saying the same thing in the Wall Street Journal. Earlier this week.
I think it's naive to think there isn't politics.
Are we going to say the Fed is the fall guy for this cycle if we have a recession?
Well, always you're
going
to do that. But, John, I'm going to be honest. The British do this way, way better than the Americans, where I think in Britain there's an overt politics within Bank of England discussion, including a foreigner sitting on the board, which is really cool.
I think it's very cool as well. Catherine Mann's turned out to be quite hawkish, Tom.
Yeah, but we don't do that. We're like, there's no politics involved. Baloney. There's politics involved.
I'm not sure if anyone believes that after the debacle, Lisa, of the last 12 months.
Yeah, but there are two debates here. There's two sides to this story that I think are interesting. And the politics is definitely, they're very much there, and a lot of people talk about it. But there's this idea that it's worse to torpedo economic growth by raising rates too quickly. That's the Warren camp, the Claudia Sahm camp, versus there's a risk of not going hard enough and allowing inflation expectations to become unmoored. These are the two camps battling it out at a time that feels unprecedented, certainly in recent history.
The political environment in Washington around this Fed is going to get much harder when the data shows much more weakness, Lisa, which again introduces this bigger call in September. The braver decision is in September to go again, right?
Well, and then they have to make the argument about entrenched inflation expectations because there's going to be weakness.
And try doing that if we start to see the weakness in the labour market.
Exactly.
And to Tom's point, that's when the big challenge comes about for this Fed. Futures up 0.9% on the S&P from New York City this morning. Good morning. For our audience worldwide on this Fed day, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Bloomberg has learned that the Justice Department is using a grand jury to investigate efforts by former President Donald Trump and his aides to overturn the election. The focus is on creating fake electors and pressuring former Vice President Mike Pence to refuse to certify the Biden victory. No comment yet from the Trump camp. Bloomberg has learned that Senate Majority Leader Chuck Schumer has told donors he doesn't think there are enough votes in the Senate to pass a big tech antitrust bill. The measure is designed to pare back the power of companies such as Apple's Amazon and Alphabet. Still, the bill's co-sponsors have maintained they do have enough votes for passage. Mercedes-Benz has raised its outlook thanks to resilient sales of new high-price models. The world's biggest luxury car maker now expects profit to be slightly higher than last year. We spoke with Mercedes CEO Ola Källenius.
We're watching inflation. We are, of course, watching central banks' reaction to that inflation with interest hikes. So it's something that we have to be mindful about. So far, we have not seen any reduction in demand for Mercedes. So demand for us currently is strong, but it's something that you have to have in mind and see how things develop into next year.
Meanwhile, Mercedes says its deliveries fell 7% in the second quarter because of a lack of chips and other logistical issues. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
A lot of the challenge that we have now is that the Federal Reserve's monetary policy is late in the face of the tremendous fiscal stimulus. They should have begun shrinking the balance sheet in 2020. They should have come off zero. I think we should focus on price stability at the Fed. I think that should be their core mission.
It was French Hill, the congressman from Arkansas, from New York City this morning. Good morning. Looking forward to our Fed coverage a little bit later. Starts around 1:30 Eastern time. The decision at 2 o'clock. And then on to 2:30, we'll hear from Chairman Powell in his news conference. Futures right now, positive 8 or 9/10% on the S&P 500. On the NASDAQ 100, up by 1.4%. Helped out, assisted by numbers from Alphabet and Microsoft. Those two names up by around about 3%. I'm with you, Tom. I'll call it Alphabet for them. I just won't call Facebook Meta.
I'm never going to call it Alphabet.
For Zuckerberg. I just can't. Meta. Company. What's that? No. Yields down a basis point, Tom. Your 10-year. 279.59. What did Andrew Hollenhorst the City say moments ago? He said he's looking for a dovish detour, but ultimately a hawkish destination.
Absolutely fascinating. It's just been a wonderful show so far this morning, folks, with this news flow. And I can't say enough about the quality of conversation, discourse we're going to have at our Fed show this afternoon. It's just really, really looking forward to that. Diane Swank will be there with a pulse of the American economy. What we do is, when required, we rip up the script. We're going to do that now with a clinic on the toughest political environment in America. It's Gina Raimondo's Rhode Island, where the knives are out always. There's 3 Republicans. They live down in Newport, down on Mansion Boulevard. And other than that, it's a Democratic Party war zone. Wendy Schiller is director of the Taubman Center for American Politics at Brown University. And she carried the train of the entering conservative Nancy Pelosi at the Brown University commencement back in May, where Speaker Pelosi said to the liberals of Brown University, hold on to your hope. Wendy Schiller, right now, Speaker Pelosi, the tough girl out of Baltimore, has to survive Taiwan. How does she do that?
Well, she navigates it the way she's navigated everything else. I think she tries not to say anything too inflammatory. I think there's a lot of pressure for the speaker to break from Biden symbolically. And this may not be the best thing for American foreign policy. That's at least what the Biden administration is saying. But essentially, from now until November, you'll see increased separation between the Democrats who are out and about wherever they are and the president of the United States. I mean, with his approval ratings, you just have to cut the cord. And this is a very public way of cutting the cord.
Wendy, let's cut to the chase, and I can do this with your definitive textbook on American history. Here's the angle. The president's a fossil, I'm a fossil, and guess what? Speaker Pelosi's a fossil at 82. Was she fragile when she visited Brown, and can she be strong when she visits Taiwan?
She was not in the least bit fragile. This is a woman who we have these very famous hills. They're not San Francisco, but they're pretty high hills. She went up and down them in heels that I wasn't even wearing that day. She is tough, energetic. There's nothing fragile about her at all. But you're raising an incredibly important point, Tom, about politics in America now. When people, not even young people, not even 20-year-olds, when 40-year-olds look at the leadership of this country, they see 80-year-olds. You know, it's one thing to see someone who could be your parent. It's another to see all of your grandparents and your great uncles and aunts running the country. And I think it contributes to the divide, and it contributes to the lack of trust or faith or confidence in the future and the leadership of the country. There is just too big a generational divide right now between the people who have the power and the vast amount of people who are living under that power.
When you talk about the divide, I want to go back to something that you were saying at the beginning, where you were saying that this is a very public way for Nancy Pelosi to create a divide with his current sitting president, and that's going to be a theme among Democrats because of his approval rating. How much does that undermine any ability he has, especially heading into this call tomorrow with Xi Jinping, to make bold moves either internationally or nationally ahead of the elections?
Well, I think the United States always has the force of its defenses and its military and its economic power. And I know that the economy is struggling, but we always have that on the table. So I don't think you ever walk into a call or a room with no leverage. But certainly to say that we will pass legislation or that he can get Congress to do something, I don't think that's credible at this time.
At the same time, we are looking at especially this economic backdrop that you're talking about. Tomorrow, Janet Yellen's going to be giving a speech after we get those GDP numbers that could potentially point to a technical recession. What do you think about the messaging so far of what a recession is, what it isn't, technical versus real?
I think voters care about how much it costs to fill the gas tank and whether they can go on vacation for the rest of this diminishing summer. They care about now their air conditioning bills given heat waves. They care about filling their grocery bags. That's what they care about. And consistently, elite messaging and elite conversation seems to be further, again, away from what people basically are experiencing. You know, whether you define it as a recession or not, if it's more expensive for me to do things, and I'm starting to worry about my job, that's what matters to me when I'm considering my assessment of politicians.
Wendy, thank you. Wendy Schiller of Brown University. Lisa, we heard that a lot in the last day or so, that if you're explaining, you're losing. They're doing a lot of explaining. And to Wendy's point, there's a lot of people that feels like we're already in a recession. You see it in some of the consumer confidence numbers.
They're in a tricky spot right now. I think everybody would agree. They do seem to be kind of scrambling, and they have been for the past few months. We heard that with the gas prices messaging, and now they have gotten a decline in gas prices. It's a really perilous message to hinge yourself to ahead of this midterm, considering that it is potentially affected by external factors. I do wonder, though, if they say this is not a technical recession, this is a strong economy, if they're basically telling the Fed, so go ahead and kill it. So basically go ahead and raise rates as much as you can.
Secretary Yellen has a point when it comes to the labour market. Tom, we're still adding 200, 250, 300, 350,000 jobs every single month. Unemployment's at 3.6%. The thing we're all focusing on is whether the weakness we're starting to identify in housing and other places, reflected in falling commodity prices because demand is starting to come off. On gasoline, for instance, another example, whether that starts to bleed into the labour market. Does it start with hiring intentions? We see it from some big companies. And does it start to bleed out into overall job cuts, Tom?
We're not there in the job market. We need to see that within the labor reports, the two reports that we see at the beginning of each month. And to be blunt, the first week of August is going to be really interesting. John, what it amounts to is the percent of your paycheck that's going to things inflated. And for a huge body of the middle class, that was a chunk that was painful before, always by definition, but now it's ever more painful. What would you suggest? It's gone from 40% to 60% of a given paycheck? That's unacceptable.
The statistic I keep going back to is the work of Bank of America from their card spending data, Tom. Low-income groups, 10% of their monthly spend is now going on gas and gas alone. 10% of their income.
Yes, but it's even food with all the substitutions we're seeing there. McDonald's talked about that yesterday. But to me, John, and I mentioned this earlier, next year is a year of debate about rent, multifamily, and the housing crisis in this country. We're focused on 3 zip codes in New York. And I mean, John, I haven't been down to your zip code, I think, in 3 years, but it's the same.
I saw you down there a couple of months ago.
It's all the same. Please, John, don't ruin the image. But it's all the same, and the coast to coast rent's what it's about. Look at the rent lift in Phoenix, which is cheap.
Tom, it's crushing. It's crushing, and Lisa's talked about it a few times. That speaks to the stickiness, perhaps, of inflation, given shelter costs. And that speaks to a Federal Reserve that's going to keep on hiking.
My debate with Holland
potentially into economic weakness.
John, with the Holland horse, it's you go from 9% down to what? Going to 5% is not acceptable.
It's not going to get it done.
Yeah.
Futures higher by 0.9% from New York. This is Bloomberg.
the consumer is not as resilient as they've been in the past. They're more sensitive to prices.
Stagflation really induces and is a precondition for a growth recession.
You've also got this fact that the world is changing. Economic volatility is so much higher now.
The market has shifted completely away from inflation concerns towards recession concerns.
For most people, it looks and feels like a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Here comes another Fed rate hike from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures positive, TK up 0.9%. We look for another 75.
Yeah, wall earnings coming out right now. Bristol Myers Squibb, ADP as well. And John, all it comes down to is it's better than good. I think Binky Chadha will give us wonderful color on this in a moment. You see it with Google, Microsoft, World coming to an end at what, 4:15 yesterday, 4:20, and you get to the morning and guess what, they're up.
I'm not going to get that excited. I'm going to call it a sigh of relief, Tom. I think others are too.
Okay.
Maybe signs of resilience, given what we'd seen in other names coming into this earnings season.
Well, but, I think this wraps around what Chairman Powell's going to have to say today, which is, we're getting along. Are we in a crisis as we try to bring inflation down? And this debate we're having this morning on the show, I think, is just fabulous. It leads to that press conference.
There are things that are happening, Lisa, that I imagine this Fed wants to see, which is maybe job openings start to come down, hiring intentions adapt, a little bit more demand come out of the labour market. We all wanted to see an adjustment in the housing sector. We're seeing that. Gasoline prices lower. Are we ticking boxes? And do those issues get bigger in a way that maybe the outcomes are undesirable?
The problem is that the market goes ahead of the Fed so much further than perhaps the Fed would like. And at this point, yes, perhaps we're ticking boxes now and perhaps it feels controlled, but it can happen in a somewhat sudden fashion that all of a sudden the market does turn and all of a sudden the economy turns and the Fed finds itself too tight. How much do they talk about this being a desirable outcome versus a weakening at a time when there are signs that certain aspects of inflation are softening, i.e. Walmart, with that retail inventory glut having to price it down?
It goes to the question you asked earlier this morning. We've been asking it a few times over the last week or so. How do they acknowledge the weakness we're seeing in this news conference, and how does that tee us up for September?
I think that they're probably going to look at the weakness that we're seeing and they're going to say, this is what we need to be seeing, but that inflation is still there, and that needs to be what we combat. They have to continue with that tone. At what point, and this is, I think, what people are going to be gaming out after this Fed meeting, at what point does the conversation change to how much does the unemployment rate have to rise, how much do the jobless claims have to rise before the Fed starts to really talk about the labor market mandate as well?
And is it rising when they get to September? That's one to look for. If you're looking for Alphabet, we are higher by 3.7%. Microsoft doing well in the pre-market as well. Futures higher by 0.8% on the S&P 500. On the Nasdaq 100 higher too by 1.4%. Yields in just a basis point or so, 279.40. The euro showing a little bit of strength. Euro dollar positive 0.4%. And crude, Lisa, back to a 96 handle on WTI.
Yeah, that's really been one major market. And I will just note that natural gas prices over in Europe have surged to record highs. So that, of course, is the backdrop, as we've been talking about throughout the morning, with a weaker Europe. Interesting that the euro is rallying a bit. Today, here's what I'm looking at. 10 a.m., we get June pending home sales. This has been one area of absolute devastation. If you look at how much the volumes have dropped, plummeted in the home sales transaction data. Yesterday, we got new home sales plunging to the lowest levels going back 2 years. At what point do we see an ongoing weakening here that is not yet reflected in prices, may take a while to go into rents, but highlights how quickly this market is responding to what the Fed is doing? 2 p.m., we get the FOMC rate decision, followed by a 2:30 p.m. press conference. We get to speak with so many wonderful guests for the Fed special, which will start at 1:30 p.m. Mohamed El-Arian, William Dudley, Diane Swank, all joining us to really parse through what we should be looking for and really what the Fed is trying to say, because we have known that some of these commentaries have been more accurate than the market immediate reaction, the knee-jerk reaction, which has tended to lag behind the realization that comes several weeks later. I'll just say that. Earnings do continue also after the bell. Qualcomm, Meta, Facebook. I will do this for you, John. And Ford Motor, we have seen a complete sell-off. How much has been already priced in? And I think that is really the key, John, because we aren't hearing the best news out of these earnings, right? I mean, these are not stellar earnings. There have been a lot of beats that have been below average if you look at historical quarterly earnings periods. So at what point are we just seeing a market saying, okay, at least it's not the worst case scenario, so we can start buying again?
Yeah, Facebook has been an ugly story. That's why it's down by more than 50% year to date. Bramo, thank you. Binky Channa joins us now, Chief Global Strategist and Asset Allocation Head at Deutsche Bank. Binky, you're asking an important question. Are we seeing signs in this earnings season of rising corporate risk aversion? What do you see, Binky?
So far, I wouldn't, characterize the earnings season as showing sort of widespread or broad-based signs of corporate risk aversion. But, if you take a sort of wider look as to whether we are going into recession, what I would argue is, pretty surely we are doing so, but we're doing so, pretty slowly. So I put it as pretty surely, but slowly. As far as earnings are concerned, we are coming in, right now, as of yesterday evening, at below average beats. I think you got to keep in mind that S&P 500 earnings almost always beat by about 5%. We're running at about half of that right now. And of course, that's going to sort of keep changing.
Right.
But I would say, the important thing to keep in mind here, since we are talking about recessions, we are concerned about declines. This is really the first quarter in 2 years that, while the headline number looks fine at 6, 7, 8% growth, a lot of that is just simply coming from energy, which we all know all about, from oil prices.
Right.
Ex-energy earnings are actually down for the first time year on year. You look at it sequentially on a seasonally adjusted basis, they're down by a good 3 or 4%.
Okay, Binky, what's so important here is you and I could talk for 3 hours about this and never run out of questions and insights on this. I want to cut to the chase, which is sector analysis over the next 3 years has to be absolutely critical. How do you choose which sectors to go into? You're at a table with Folkert Landau. He's foaming at the mouth about a need for a weak dollar. Somebody else is nuts about foreign exchange. All this other noise right now. Forget about it.
Mm-hmm.
3 years out, how do you choose which sectors win?
So I think you have to play the sectors according to, your view on where you are in the cycle and where we are basically going. I would argue the probabilities of recession have gone up, and there's little choice but to be long the
So what's your
defensives.
overweight sector right now?
So it would be staples in the healthcare on the view that, we are basically
United
going
Healthcare
down.
has a drawdown of 2%. Nobody knows that. Gloom, 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 gloom. And a Dow component. John, it's a Dow component. Remember that. United Healthcare's down 2%. Yeah. I mean, that's the resilience, right?
Yeah. It is, but I think you have to keep in mind also that your question, Tom, was over the next 3 years. So
Please.
I would definitely not keep it stable in terms of your sector preferences. I think it's important to keep in mind also that everything goes down in a recession. It's just sort of a question of, when in the cycle. So staples and healthcare hold up pretty well, but they do go down. And if you look at sector performance across recessions, actually, yes, the defenses outperform, but they outperform relatively modestly because eventually they do sell off too.
Binky, I want to just double down on something that you were saying that I think is truly fascinating, that it's going to take more than just misses or not as big beats as people expected. It's going to take that caution from the C-suite to really drive valuations lower and cause a bigger sell-off. So at what point do we know we've seen that caution? I mean, Ford's cutting jobs, Shopify's cutting 10% of their workforce. We're seeing Microsoft, Google, everyone is basically ratcheting back their hiring expectations. At what point does this qualify as caution?
Yeah, so, I would tee off sort of on a remark that you made earlier, which is that, things can happen kind of suddenly. The way I would characterize it is that recessions are really, inherently sort of nonlinear events. Many of the things that you mentioned, I would say, are sort of, pieces of cautious news. It hasn't sort of piled up into one. But there's plenty, sort of negative, and that's why I say, we're definitely drifting down as far as the economy is concerned, but we're doing so sort of slowly. And obviously it means, you're vulnerable to a negative shock, but it also means that the inherent dynamics at some point, somebody bigger moves in terms of an employer, some idiosyncratic shock perhaps, and that gives cover for, other people to move. So far it's slowing down in hiring. It's modest layoffs. It's not some big sort of non-linear event. But everything is pointing in the direction of us going into a recession, and I would say the probabilities are basically rising.
Slowly but surely, or surely but slowly, as you said, Binky.
Surely but slowly,
Binky,
yes.
awesome to catch up, buddy. As always, Binky Chandler there of Deutsche Bank. Just work the numbers for you, TK. Apple's market cap is 5 times bigger than United Health's, yet on the Dow, United Health has an 11% weighting, and Apple has 3%.
It's amazing, yeah.
Weighting.
Yeah.
I mean, doesn't that just defeat your own argument?
No. I think it's a Dow component, and it's a good and beautiful thing.
The biggest
What's
weighting
really
on the
stunning-
Dow, United Health
but
is.
What's really stunning about this, John, is United Healthcare hasn't pulled back like Apple. I get it. So the 10-year annual return on UNH is a stunning 28%, where Apple's 22%. I mean, how many people watching this, listening to this, would say a boring hospital company is going to outperform Apple? Nobody believes that except Bikram Chadha.
Well, perhaps in this environment, yes, Tom. I think that's the issue here. And to Binky's point, slowly but surely, or surely but slowly, going into a recession. And his sector picks were pretty defensive, Tom.
Yes.
Based on that.
Yes.
Staples, healthcare.
Yeah, they're all Dow components.
It's kind of what you'd go to. Okay. Are you passively allocated to the Dow? Are you like the only guy?
I am I'm in the Chadha Dow Jones Industrial Average Fund with futures up 113.
I guess we haven't had this argument for a month, so
it's been hours.
Futures up 0.75% on the S&P. Bramo, you're meant to step in and stop this stuff.
No, I'm enjoying it.
On the NASDAQ, up by 1.3%.
I don't always stop a Dow argument. That's just an unstoppable force.
Facebook coming up a little bit later after the bout. Then Apple and Amazon coming up tomorrow.
Facebook.
Thank you, Tom, from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The Federal Reserve is expected to raise interest rates by another 75 basis points today. Traders will take a close look at the language of the Fed statement to see what it thinks of the path ahead. The central bank is likely to acknowledge there have been recent signs that the economy is weakening. Now, President Joe Biden will speak with China's Xi Jinping tomorrow. The call will take place at a difficult juncture for U.S.-China relations. House Speaker Nancy Pelosi's staff has not ruled out that she will visit Taiwan next month. China has warned against a trip. Beijing considers Taiwan part of its territory. The first Chinese city to impose a coronavirus lockdown has now imposed another one. Wuhan has locked down a district of almost 1 million people on the outskirts of the city after 4 cases were found. People have been told to stay in their homes, and public transport has now been stopped. For the second night in a row, the 2 Conservative candidates to succeed British Prime Minister Boris Johnson battled it out in a televised debate. Foreign Secretary Liz Truss and former Chancellor Rishi Sunak clashed again over the economy. Both accused each other of pursuing policies that are morally wrong. The debate was cut short when the moderator fainted. The debate organizer says she is now fine. And Credit Suisse has tapped a veteran banker Ulrich Kerner to be its new chief executive officer. The Swiss bank also said it will conduct a strategic review of its investment bank and other businesses. Kerner is the head of Credit Suisse's asset management unit. He will succeed Thomas Gottstein, who's resigning after 2 years marked by scandal and also huge losses. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
Everyone's looking for another rate hike today.
Central bankers basically going to take a sledgehammer to inflation.
But will the Fed be able to steer clear of a recession?
We've got inflation, we've got a bit of a weakening labor market, and we have concerns about recession.
Trust Bloomberg for the fastest coverage and exclusive analysis.
This year's people that are calling for inflation peaked are last year's people that called inflation transitory.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
You got the job market very strong. You've got inflation still running hot. And yet at the same time, you've got GDP growth stalling out. And so the Fed's got to figure out how hard to step on the brake to weigh off how hot the economy is. And that's a messy proposition.
Messy is the right word. That was Austin Goolsbee there, the former chairman of the Council of Economic Advisors, on this Fed Decision Day with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures look like this. Positive by 0.8% on the S&P, on the Nasdaq 100 up by 1.3%. Yields unchanged, 279.77 on a 10-year. Euro-dollar, euro showing some strength. Euro-dollar 101.66. Our attention right now on President Xi, Tom. He's delivering a speech to local government officials. Some reporting out of China saying that Xi is saying the party Congress is to plan a major task for the next 5 years, that the challenges that China faces are more complicated than before. Bit of tension, of course, bubbling away between the US and China, always is, over Speaker Pelosi's potential visit to Taiwan. Tom, this from Mitch McConnell, the Senate Minority Leader. He basically said Pelosi not going to Taiwan would hand China a victory. So now there's this pressure coming from the other side of the aisle about the speaker actually going. Complex is the word, Tom.
The headline here is it's July 20 Fed Day, and the answer is she's scheduled for August at some point, and maybe her travel agent will amend that in some face-saving form. We'll have to see on that. To this Fed meeting today, and Axios featuring it this morning, the divide of the middle class in this country from the haves. We speak to Anne-Marie Horton, one of the haves, our Bloomberg Washington correspondent, on the great middle class. Anne-Marie, the Pew Research people showed a poll ages ago, Romney Obama, I think, which was the massive divide in policy of the haves, the wealthy, and the have-nots. Right now, the have-nots, we all agree, are getting absolutely crushed by a set of inflations. Does your Washington know there's a middle class out there somewhere?
Well, I think both sides are trying to talk to the middle class, right? They all say that they have the better policies, especially ahead of the midterm elections, to try to make sure they can rejuvenate and reboost the middle class. But it is true, there is this bigger socioeconomic divide. And you really saw it during COVID, that just grew larger and larger, right? Those that have investments in the stock market or have good jobs, they were saving even more. Their wealth just was rising, while there was others that were losing their jobs, didn't have a lot of money in the stock market, and really struggling. And now what you have is that inflation hits everyone, right? Everyone feels price pressures and inflations, and they see it going up. But it obviously hurts lower income individuals in the middle class much more.
Is it like a Bush of long ago saying it's the economy stupid? Is this time around none of this matters because it's crime stupid? I mean, is that how odd it is in a debate with the middle class of the haves inside the Beltway?
Well, if you look at poll after poll, it's inflation that continues to be the top of voters' minds. So, yeah, in terms of Carville's "It's economy stupid," it's the fact that individuals usually go to the polls depending on where they are in terms of their grocery list, gas prices, et cetera. And we've seen the administration come out. Just last night, the vice president came out talking about how gas prices are now lower. And I think today the AAA average is $4.30. But this election is also going to be interesting because I think there is another issue at hand that the Democrats are really going to push forward as we get closer to November, and that will affect women. That's, of course, women's reproductive rights.
I want to focus in, Anne-Marie, on the gas issue, especially because we heard a new proposal out of the White House to potentially offer some guaranteed purchases of gasoline, of crude, later on as they do release some of the reserves now, basically guaranteeing demand demand for a lot of the big oil companies later so that they increase production now to incentivize them. How do people respond to the nuancing of some of the tools that this White House is using to try to combat gas prices over the longer term?
I think the majority of Americans don't really care about how it's happening, right? What levers are you pulling? Who is increasing production? Is it the kingdom? Is it Houston? Is it coming out of the SPR? They just want to see the ticker price go down. I think that is broadly how Americans feel. But of course, it's a difficult one for the administration because at the same time, they do want more natural gas production, obviously more oil production coming out of the United States. They want to see it coming out of the rest of the world. They want to make sure Russian oil stays on the market. That's why they're trying to negotiate this price cap. But they also are pushing a clean agenda. And it's very hard sometimes to get these oil and gas producers to want to sign up for infrastructure that takes 5, 10, 15 years of investment when what they're saying is we need your oil today, but we really don't want it in the future.
Anne-Marie, how did this whole thing around explaining what is and what isn't a recession begin? How did this start?
So I think this started when a few days ago, the White House posted a blog on their website discussing what a recession is. There's clearly some nervousness, I think you could say the least, within the White House and the Treasury, very close to me as well, about if we get a negative GDP preprint, what people are going to say is we are in a, quote, technical recession. That's not the definition in a sense, but you have not seen a recession before in the United States without back-to-back consecutive quarters of negative growth. So I think what they're worried about is how this is going to be talked about in the press and the media. We already see, if you do a Bloomberg terminal search, on the rise, the word recession is in the media. So they are trying to come out and talk about it and get ahead of potentially bad news. But the issue and the risk they have is they might have dug themselves a hole now, because now only thing people are talking about is if we're going to be in a recession, are we already in one, and what is the definition of it?
We're talking about it now because they're talking about it. AMH.
Exactly.
Down in DC, Anne-Marie, thank you. Nomura's looking for a negative print tomorrow. Credit Suisse is looking for a negative print tomorrow. Bloomberg Economics is looking for a negative print tomorrow. Deutsche Bank is, UBS is. Can keep going through the names. TD, Moody's, Pantheon, Bank of America, Visa. There's a lot of names looking for it, Tom. The median estimate, though, still is just about a positive print. But there are some names out there looking for it.
Yeah, and it's going to be the makeup of it. I'm going to really look at what the pros are looking at, which is the domestic final sales dynamic, always important. But what we're hearing from pros is it's esoteric. The inventory build could be the swing either way.
Underlying domestic demand, Lisa, what does it look like? And is it getting weaker relative to where it was?
And honestly, how are they going to really position this if you're starting to see housing prices and housing rents climb so significantly, and if the people are facing just bills that are unaffordable based on their pay raises?
It's brutal for a lot of people. Futures right now up 8 or 9/10% on the S&P, on the Nasdaq up 1.4%. Here comes another cut. JP Morgan now seeing a recession in Europe after Goldman now sees a recession in Europe coming. The new outlook's just getting slashed by the minute. This equity market bottomed the day after the Fed last met. We've rallied ever since. We're rallying this morning. We've got to bounce again up 0.8% on the S&P. Your words, not mine, Tom. I'm not going there yet. The Nasdaq up by 1.4%, helped out by two names we can build on in just a moment, Alphabet and Microsoft. Bramo's going to go through that for you. In the bond market, yield shaping up as follows: 2s, 10s and 30s looking a little something like this, unchanged on 2s. Coming in a basis point on a 10-year, 279.40. Wanted to spend a little bit of time on Europe. JP Morgan, the latest bank to look for a recession in the Eurozone year-end. Goldman doing the same in the last 24 hours. Here's the quote from them. We now look for a combination of higher European natural gas prices, reduced gas supply, Italian political risk to slow Eurozone GDP. And Tom, when it comes to the euro at 101.60, here's their call for the ECB. They're not looking for 50. In September, they're looking for 2 more 25 basis point hikes by year end. Then we're done.
It's the parlor game, and you know the guests we're going to have coming up here is going to lean towards that angle. The raging debate. What's Bill Dudley going to tell us this afternoon? He's going to be with Anna Wong. Let's go, go, go.
Hey, Bill's made the point, and Bill's made the point since June of last year. I should stress, Tom,
Yes.
that this Fed's going to have to go further, do more, and go higher than people thought.
It's absolutely I just can't say enough about how we need to engage the debate to inform people. So, ultimately they can make investment decisions,
Tom, I'm with you.
particularly on retirement plans.
I
I'm not triple leverage cash. I mean,
You
my
think of
retirement, I was not going to retire, but I'm considering it now, John, with that resilience.
Tom, I think later it's really important to point out that on our Fed show, and of course I'm singing our praises, but we're speaking to two people who were dead on. They were right. Mohammed Al-Arian and Mr. Dudley, formerly of the New York Fed. And that's the beauty of the program coming up.
That's okay.
Futures, positive 8 or 9/10%. A couple of names responsible for that move. Let's get to Bramo for more.
Yeah, it has been Microsoft and Alphabet, and the idea that they didn't come out as bad as expected and came out with actually positive forecasts. That's why Microsoft shares up 3.3% ahead of the open. How much does that color this landscape for all of the other firms that perhaps are not as big and dominant as some of the tech giants? I'm thinking of PayPal Holdings. Those shares up 6.7%. Why? Because Elliott Investment Management reportedly, as per the Wall Street Journal, has amassed a big stake in this company to accelerate job cuts. That is the other theme that I'm looking for. How many companies talk about job cuts as they take a look at a weaker potential scenario? We saw that from Shopify, which is down 6.4% after reporting earnings this morning. Yesterday, they came out and they said that they were planning to cut 10% of their staff, about 1,000 people. Again, it's the haves and the have-nots. The haves, the Microsoft and the Alphabet. The have-nots, perhaps Shopify, perhaps PayPal. Also, what we are looking for is some of the other companies that are going to be reporting, including Facebook. Fine, I will not call it Meta, although I do like the philosophical kind of environment, John. I do think that, they're onto something with
What
Meta.
are you
I think I want to
talking
just tweak you a little bit and see how much I can
Why do you
wind
like
you up.
it so much?
I just think, it makes me feel existential. Meta is up 2.4%. Again, I really do think that this is something where we should look at the tick-by-tick movements, but rather what has been priced in already. These shares down more than 50% year to date, so a 2.4% increase, not exactly significant. However, does it indicate that the bottom is in? Is that what basically the market is saying, even though there hasn't been exactly screaming optimism for some of these earnings? Amazon shares up 1.4%. Those shares down 30% or some odd plus or minus year to date. And Apple shares up 0.8%, down about 14% year to date. Tom, how much do we see the resilience in some of the physical goods at a time when Apple is cutting prices in China?
To your point, and Louis Vuitton did this earlier on China. I'm sorry, but Apple on China is going to be a complete mystery.
Yeah, and how much does this really replicate what we're seeing elsewhere, or is this just a China story?
Okay. Well, you're talking, Lisa, Boeing out with earnings. I have no idea what they are other than I can't afford a plane ticket. 787 chat, 737 max chat, positive opera free cash flow. They're all about free cash flow. I remind campers that Boeing, from the miserability of pre-pandemic, is down 64%. It is not Airbus, to say the least. Right now, we're going to migrate over to yield and what these Fed meetings today and forward mean. And we do that with Bob Miller. He's head of America's fundamental fixed income at BlackRock, on the edge of legendary at Bank of America just a few years ago as well. Bob Miller, you are the perfect one to talk to about the arch Fed debate, that they will act and then they will wait and watch for data, or they will act boldly and move on the edge of Paul Volcker. Which are you gaming that they will do?
So today, Tom, I think Chair Powell is going to try to thread the needle between the two, but probably ultimately lean toward the Volcker, slightly more hawkish, only because I think it's too soon for them to tilt the message in a way that would be interpreted as dovish and provide more relief to financial markets.
Bob, do you think
it's coming? I do think it's coming. It's just not today.
Bob, do you think that it's realistic to be pricing in rate cuts as soon as next year?
Well, remember, the market's pricing 75 today and plus another 100 by the end of the year. And then it has 50 to 60 basis points of rate hikes later in 23. I think that's way too clever to think that we're going to actually go all the way to 3.5 and then be at 3 or slightly below 3 by the end of the year. I think it's much more likely that either we don't get to 3.5 and the Fed stops sooner, but doesn't have to cut, or they have to go beyond 3.5 because inflation just proves wildly more persistent. And there are not only are there no cuts, there are more hikes in the second half of 23. But the current curvature strikes me as I think we like that trade. We're taking the other side of that.
Okay, so you're taking the other side of that, which means you're going short duration and you're going into the short end. How is that playing out in terms of your investments?
Well, it means that we're actually we've got that steepener on. We're long the very front end of 23 that's implying a 3.5% terminal rate, and we're short the back end that's implying those cuts that you referred to.
Bob, on the yield, if we get, and this is important to link your Fisherian from yield over to inflation, from inflation over to yield. If inflation comes in and we go 9, 8, 7, maybe we get down to 6 or 5, and we stop, what does that do to the total return of fixed income?
You know, Tom, I think what's good. So first of all, the year-over-year numbers are going to be really tricky over the second half of this year. There are some base effects that actually push them up over the next, in 3 to 4 months down the road, not continuing to push them lower as we saw in the spring or began to see in the spring. So, we've had this view, and I think this persists. What the Fed will be looking at, in our opinion, and what I think the market will be reacting to is kind of take the 1, 2, or 3 month annualized run rate of the month-over-month prints. Now, there's been no relief on that front yet, but we do think that's coming. We think the month-over-month prints are going to decelerate into the end of the year such that core PCE, the Fed's preferred measure, will be running, let's say, on a 2-month annualized basis or 3-month annualized basis, will be running something much closer to 3% by the end of the year than the current level. So I think we're going to have to take those shorter term indicators and look, or shorter time horizon indicators and annualize them. And that's where we will either get comfortable that inflation is in fact decelerating, or we won't get comfortable, as some of your prior comments around other speakers have suggested.
Bob, in the meantime, the calm technical talk as people parse through the possible Fed scenarios belies the incredible pain in bonds, certainly for the first half of the year. Then the whipsaw rally that we saw over the past month or so, you're betting against that. You're saying that you're basically seeing the long end, 10-year, 30-year treasuries sell off in some sort of significant way. How significant could that be as we whipsaw in the other direction?
So I fear I've misplaced my my steepener view, which it's a really micro steepener in the very front end of the SOFR curve. So it's not 2s, 10s, or 10s, 30s, or any of that. I actually think the Treasury curve offers modest value here. There are other places in fixed income that got to reasonable value a month ago and have since rallied in quite a bit, like U.S. high yield and some of the investment grade market. But fixed income started, part of the challenge for this year is that valuations were so rich in 20 and 2021 due to the persistence of extraordinarily accommodative monetary policy that there was no place for returns to go but negative, and it was just a question of how negative would they be. And now we've had this slaughter in the bond market globally and across all sectors of fixed income. But we've, at least a month ago, we got to valuations in some places that started to look reasonable to us, and we started to add. So I do think fixed income is setting up for a reasonably good 18-month ahead period if we're right about the deceleration in inflation, albeit not a rapid one, but nonetheless a persistent deceleration over the course of the next year. I think fixed income returns are going to be much, much improved. Pretty low bar, but much improved over the next 18 months.
I could sense that in your voice then, Bob, at the end. Bob Miller of BlackRock. Pretty low bar at the moment because things have been that dire and that tough for so many people. Too soon seems to be the takeaway for the pivot. I'm getting the same message in my inbox right now from George Goncalves from MUFG. Too soon to make the pivot, Lisa. We've got 2 more prints, and to Bob's point, we've got the August 10th print on CPI. Yeah. I think the next one's September 13th, then September 21 for the Fed, and let's see what things look like.
Okay, but if September is the time to make the pivot, right, is that too soon, right? At what point do you say there's enough data under belt, especially because the big concern out there is that the Fed backs away too quickly and then inflation expectations get unmoored and the market gets even more disrupted down the line?
How can you pivot without a constructive real yield environment? That's what Dr. Dudley's going to say.
Tom, I'm with you. I think it's hard to make any kind of pivot.
To
never
push
mind a
against
pause.
Claudia Sahm, I mean, within normal finance that I learned, Finance 101, I don't think Claudia Sahm ever took a finance course, but good morning, Claudia. But John, what's important here is you got to generate some form of normative real rate. You're not going to do that with a pivot in September.
We just had a really hot core month-over-month read, and we've got a headline number with a 9 handle.
I don't care. I'm in triple leveraged all cash, but
pretty tough environment for the Fed to make a pause, a pivot, whatever your choice of words. Futures right now up 0.8% on the S&P and the Nasdaq, up by 1.4 on this Fed day. Good morning to you.
Fed day.
This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Bloomberg has learned that the Justice Department is using a grand jury to investigate efforts by former President Donald Trump and his aides to overturn the election. The focus is on creating fake electors and pressuring former Vice President Mike Pence to refuse to certify the Biden victory. No comment yet from the Trump camp. Bloomberg has learned that Senate Majority Leader Chuck Schumer has told donors he doesn't think there are enough votes in the Senate to pass a big antitrust bill. The measure is designed to pare back the power of companies such as Apple, Amazon and Alphabet. Still, the bill's co-sponsors have maintained they do have enough votes for passage. Now, Deutsche Bank warns that it will miss a cost target for the year. Plus, it says that a key profitability goal was getting harder to reach. We did talk with the CFO, James von Moltke.
Look, the environment is worsening, hence our own outlook for the firm. We do see a softening of economic conditions in the second half of the year and potentially a recession, at this point a modest recession in Germany and a slowdown in Europe. So that's something we're preparing for and obviously our clients are preparing for as well.
Meanwhile, Deutsche Bank did benefit from a strong performance in fixed income trading, which beat Wall Street in a volatile market. Shares of PayPal jumped in pre-market trading. Activist investor Elliott Investment Management is building a stake in the payments giant that has been firing staff and also closing offices. Bloomberg has learned that Elliott plans to push PayPal to speed up those cost cuts. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
We forecast that growth in the euro area is going to slow down to 1.2% next year in 2023. But we highlight that in case there would be a full shutdown of Russian gas flows to Europe, the downgrade could be much more severe by another 0.8 to about 2 percentage point downgrade in terms of the economic activity for the area.
At this point, anything in positive territory for Europe feels like a reach. That was Pierre-Olivier Gourinchas, the chief economist of the IMF. For global GDP, the IMF has gone from 4.4%. That was the call in January, down to 3.6%. That was the call in April, down to 3.2%, Tom, for this year. You can see the direction of travel here, can't you?
Yeah,
they're
managing it, and there's no question about that. Everybody's doing it. I mean, nobody knows what the future is, but a major shout out, John, to WTO, which was at 3.0 or even 2.8% global GDP, and we all laughed at them.
As you pointed out, Tom, they were early on it. Everyone else has followed.
Just absolutely
I agree.
nailed it.
Futures right now up 0.8 TK on the S&P and the Nasdaq up by 1.4. Tech earnings pretty decent relative to what was expected, and here we are.
And when we travel to Morocco for the IMF annual meetings, I think that'll be interesting, John, to say the least.
Is that why you put that piece of sand in this rundown?
Yeah, that's why I did that.
Okay, that makes sense now.
As well. Interesting, and I'm really going to emphasize here, Nasdaq up 1.40% gets my attention in the heart of earnings season. This is a joy. Regina Mayer is with KPMG. She's global head of energy, and with a much different view on energy than just trying to game out what a barrel of oil is going to be. It's on a larger sphere. And Regina, I want to go to the Pacific Rim. You had the joy of working at the Pentagon with the Supreme Allied Command of NATO and all the rest of it as well. So let's go global Pacific Rim. You're in the camp that Pacific Rim demand is one of the definitive variables here, isn't it?
Yes, absolutely. Asian demand is going to continue to grow. And you're seeing that driving up short-term LNG spot prices because Asia's worried that Europe might hoard gas in the meantime because we're really worried about a cold winter and what Russia is doing to the European continent.
Help me with the x-axis here. I'm at a KPMG seminar, and I'm the wise guy going, you can't give me the direction, you got to give me a timeline. Help me here with the x-axis of when Asian demand ex-COVID clicks in. Is it immediate? Is it a quarter out? Is it 3 years out?
I actually don't think it's that far out. I think it's coming in the latter part of calendar year 2022, which is why I think the temporary pullback in crude and gas prices or crude oil prices is a temporary reprieve because the basic supply and demand fundamentals haven't changed. And OPEC is producing under capacity, 3 million barrels per day, and we're about to see demand continue to go up. So I'm calling triple digits through the end of the calendar year and into 2023.
Regina, let's paint this picture a little bit more because it's pretty striking that you're saying that Chinese demand is going to come back online ex-COVID by the end of the year at the same time that Europe could be facing a cold winter with Nord Stream 1 potentially curtailed or cut off completely based on the recent actions of Russia. How much do these two stories feed together? Does the demand for fossil fuels, crude, replacing some of the natural gas, take over and add to the demand that causes prices to rise heading into the year?
Well, I think that's definitely the story that we're trying to balance, Lisa. Is we have extremely rising demand. We're actually back to pre-pandemic demand levels without China fully entering the global mobility process. And we continue to have restricted supply. And as I've talked to y'all before, we can't turn on a spigot, right? There is no global spigot. And I do think we're finally realizing, and it's coming true in terms of what we're seeing in the market, that OPEC Plus does not have the extensive spare capacity that we had hoped they might have that would help us get through this.
Which goes back
to seeing prices. Yeah, go ahead.
Which goes back to demand destruction. And have we learned any lessons from the previous a couple of months in terms of the price point that really causes that demand destruction that so many people are looking for?
I was exactly just going to go to that point because we are at the price point where we should have seen demand destruction. But because we have so much pent up demand from a pre-COVID perspective or during COVID, we haven't seen people stop driving, stop flying. Now, there are some economists that say a lot of those tickets were purchased 3 to 6 months ago. So we might actually see the dip in demand that could coincide with Chinese demand coming back into the marketplace, which may give us a bit of a reprieve that could help us as we go into the winter months. But right now, I'm really worried about a cold winter in both Europe and the United States.
Regina, you're in Melbourne, Australia, which I believe is distant from Perth. And I look at the gas prices of Perth versus Melbourne, Australia. And the bottom line is this is it's expensive. It's like $8, $9 a gallon for gas. How is Australia dealing with that?
Yeah, I think they were calculating that it was maybe closer to 10 because I was talking about how in the U.S. we had hit record highs of $5 per gallon of gasoline, and they were saying that would be equivalent to us at 10. It's they're not even feeling the bite here. I mean, I think we're dealing with wealthier countries that have insatiable energy appetites, and they're able to move around the country and take advantage of what their relative prosperity brings and their relative access to natural resources. So I'm down here proselytizing that the world needs more oil and gas in the short term while we continue to try to drive decarbonization for the planet. We can achieve both objectives, but let's not starve the planet of the resources that we need for societal benefit.
Regina Mayer, thank you, of KPMG. TK, very impressed with your knowledge of Australian geography and your pronunciation.
Yeah,
some of those cities too.
Yeah, there's a huge distinction here between Perth, which is, I believe, on the edge of the Pacific Ocean over in the west of Australia.
That's Western Australia, yeah.
And Melbourne, which is like wicked urban grown
Victoria.
up. And the way the pros look at this is barefoot vibe versus grown up.
You know, John,
is the difference.
Basically, Tom said Perth correctly once by someone who is Australian who told him that. So that's the reason why he mentions it.
I'm aware. I've got no idea.
It's a barefoot vibe.
What that was about. Okay.
You got to watch the snakes, but it's a barefoot vibe.
Futures on the S&P up by 0.8%. On the Nasdaq this morning. And good morning to you. The numbers out of Alphabet and Microsoft supportive of this move this morning, up by 1.36%. You ever been, Tom? to Australia?
No, I've been supposed to go a couple times, and Redo, keeper of the Amex, has just said no. I made it to Singapore like 3 times, and Redo called me up and said, Tom, it's just not worth doing.
It's very cool, Tom. Spent some time in Brisbane and Sydney.
I read all of Neville Shute. I feel like I know Adelaide Springs.
Okay.
A town like Alice.
Going to talk about Europe briefly. Euro dollar 101.58, positive 0.4%. We've now got JP Morgan. We've got Goldman Sachs. Bramo calling for a recession year-end in Europe,
How
and
can I
that's the
focus now,
direction.
John? You got me on Australia now. All I can think about is
let's
the
talk about
Veronicas.
natural gas. All we can talk about is natural gas. Maybe we can focus on that because that has been so much of the focus in Europe. You're seeing those prices surge, especially as you do see Russia willing to play politics, willing to use the supply of natural gas is basically a war tool as they try to figure out how to gain some leverage here.
I love that you say all we can talk about is natural gas, and there's this echo of Tom talking to himself about parts of Australia.
Yeah, Brisbane, Gold Coast, Veronicas. Come on, get with it, John.
TK, I know.
It's a barefoot vibe.
I've no idea what that means.
You want to tell us? I'm not going barefoot in Australia.
I don't think you should.
Thank you.
Spiders and stuff, Tom.
Exactly.
Yeah, exactly. The important stuff.
What's going on?
We're going to see the weakness spread into the broader economy.
The market has shifted a lot to bad news is good news again.
The Fed is really concentrating on the single mandate of the dual mandate, which is inflation.
There's expectations the Fed could pivot in early 2023. That sounds optimistic to us.
The Fed, even if it makes mistakes, has proven that it does the job.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Fed Day on radio, on television. Yes, we'll be here for the next 6, 7, 8 hours. Stay with us with a terrific set of guests. Mohammed El-Arian. I haven't talked to Mohammed, John. I think Nixon was president.
Mohammed's
the
great.
Jets won.
Hey, Tommy called it. And that's the important point about our programming later. We'll catch up with 2 people who were dead on. Mr. Dudley, formerly of the New York Fed, and we'll catch up with Mohammed too.
And Diane Swank on the pulse of the American economy. We're going to do that with Alicia Levine on the equity markets here in a moment. John, the frenzy on my screen is important, and we haven't talked about it this morning. 2's 10's curve inversion does more. It's redoubling down, as Priya Misra talked about a week ago.
You've picked up on the tension, Tom, the tension between a hawkish central bank and what's happening with the economic data. The data's getting weaker, Tom. Not in a major way, but slowly but surely we're seeing that. And that was Binky Chowdhury's point earlier from Deutsche Bank. You see it in claims the last 3 weeks. We see it in housing. We see it in hiring intentions. Well, you see it in a more pronounced way as we work our way through the rest of the summer.
Let's go to earnings right now as we get ready for Alicia Levine here. I'm sorry, up 1.3% on NASDAQ. Microsoft and Google, they were terrible, John. It was just a mess.
The word for Microsoft, resilience. The phrase for Alphabet, a sigh of relief. And that's enough to drive this market high this morning, Tom. If you were getting defensive and you were looking for the likes of Microsoft to provide you some resilience in a market, an economy like this one, I think they demonstrated against a lot of headwinds, Tom. They can give you that. Likewise for Alphabet with the ad revenue over at Google. I would emphasize, though, and many others have done the same thing, a sigh of relief. I wouldn't say it was emphatic, Tom, more just a sigh of relief.
And then you look at guidance out. Boeing's going to have important guidance here, up 3 or 4% today. That's a unique and idiosyncratic story. But Lisa Abramowicz, all of this, and I'm going to go to Visa, which had a killer report along with American Express. It really indicates, Lisa, the 2 Americas Jerome Powell deals with at 2 o'clock.
The 2 Americas on Main Street, but also the 2 Americas within the corporate world as well, because there are the haves, which are the biggest and the boldest, and the ones with the biggest cash war chest, as I know that you track, Tom. And then there are those that are more speculative, that have been growing quickly in the pandemic, and you're starting to see them pull back. You're starting to see them cut jobs. How much is that going to be the theme? Because we have heard from a number of companies, how much does that become an escalating trend as the quarters tick on?
To get to the data, to get to Alicia as quick as we can, John Ferro, 2's 10 spread, a negative 27 basis points. To me, that's front and center.
Equity futures up nicely. That's the story on the equity side. Up 0.8% on the S&P, on the NASDAQ, up by 1.3%. TK taking a look at the 10-year yields, lower by just about a basis point, 279.59. The euro showing some strength going into this Fed call. Euro dollar 101.48, up 1/3%. And I'm getting a ton of emails now, Tom. Here's one out on Twitter. Good day, Jonathan. Tell TK we're waiting for him to come to Melbourne. great barefoot vibe here, exclamation.
Love it.
Mark. How much of this stuff am I going to get now for the
Come
next
on,
8
John,
hours?
7 p.m., 8 p.m. at night. We're out there in the beautiful dark of a Melbourne summer, which is, I think, like January or February. I can't remember. And the
It's
three
the
of us.
opposite to us, Tom. That's right.
It's like, it'd be
I'm aware
great.
we have some audience down there, and
Yeah.
good evening to you.
Good evening. We could watch cricket and fall asleep. Here's what we're going to do, and this is really timely and important. Alicia Levine, she wanders by with BNY Mellon Wealth Management, head of equities and capital markets advisory. But what she understates is an absolutely prodigious mathematical foundation, which is part of her strategy forward. Alicia, with the mathematics of the moment, are there smooth curves and glide paths for someone with a 3-year perspective?
So I wish it were the case, and after the first half of the year, it would be a great thing to have. We just have too many cross currents here. So as you've pointed out, the earnings that we got last night from large cap tech have largely stabilized and calmed markets because of the fear. But I'd say overall in the equity market, if we're trading about 4,000 here, the equity market is already pricing in the Fed pivot. The bond market is pricing in the Fed pivot. The earnings estimates are still not reflecting an economic slowdown, so those definitely need to come down. And I think the thought that the Fed is going to pivot on the first sign of top line CPI or top line PCE going lower because of the commodity price decrease, I think that's a little too optimistic. And I think we're working with an understanding of a Fed from the post-global financial crisis and QE, and not the Fed of QT. And this is a different Fed. And I think that has been largely put to the side as a left tail risk, but not a central scenario risk.
Well said, Alicia. We still got a 9 handle on CPI going into this Fed meeting, and we're talking about a Fed set up for a pause. We need to think about what's been unleashed in this economy, where we're seeing weakness and how it spreads. Where we're seeing weakness right now is in housing and housing-related industries, perhaps. I've got a ton of messages this morning about Sherwin-Williams. Sherwin-Williams, the paint maker, is down by about 13% in early trading. This is what they have to say. The shortfall in our second quarter results, demand pressures in Europe, China and North American DIY, and a continuation of the highest cost inflation seen in decades. Alicia, how do you think this weakness that we're starting to see is going to broaden out across this economy?
Look, it's a really great question. What's clear is that all those industries and companies that benefited from the stay-at-home bubble are now deflating. And the question is, how much does that deflation in the stay-at-home sector now pass into the rest of the economy and the rest of the companies? This is what we've learned from earnings season. The staples companies are doing well. They have pricing power. Thus, inflation will remain higher for that. The transition from goods to services, because goods were in a bubble, is well underway. And if you're associated with travel or leisure or restaurants at all, your earnings are fine. The other thing that we noticed on the consumer companies is that there's negative linearity in the quarter. So April was better than May, which was better than June. Something to think about as we move forward into the rest of the year as the economy slows. So these are just sort of really big picture things that tells you that transition from goods to services at some point may be a bubble also. We have these rolling bubbles as the economy heals and as we move forward to the next stage. And it's happening awfully quickly, as you can see in the sector performance of the S&P. Really complicated market, not smooth, but the VIX is at 24. The VIX isn't so worried. It's the bond market volatility that's still there. And I think until the bond market volatility subsides, it's very hard to go in, face first.
Well, Alicia, to that point, just sort of to underscore it, do you think that the market reaction, the sort of positive feel that we felt last week and the better part of this week is incorrect, is an inaccurate reading of earnings that aren't quite as positive as perhaps they're being taken as?
So I think that when the market reacts to really negative news with a stabilizing stock price or perhaps a higher stock price, that's a positive sign on the technicals, and I do not want to ignore that. So we've had companies that have cut guidance by 40%, and their stocks are now higher by 10% than they were the day they cut. That seems to suggest that in some sectors, you've already had the cut that is necessary to then go forward and grow from there. It's not happened everywhere. And most, obviously it hasn't happened in large cap tech, which is what is holding up the market right now. And so, yeah.
Lisa, Alicia, we got to get this in. It's really important. Something Ferro doesn't care about. Deloitte says back-to-school supplies now are $661, up 27% from pre-pandemic. What happened?
What happened is kids didn't go to school for 2 years. Okay, it's the same thing that's happening in travel. People didn't travel for 2 years, and children didn't go to school for 2 years. So this is a celebration of life back to normal. The question, that is where the wallet is going. It's going towards certain services and certain parts of the goods sector. But you have to ask yourself, what happens after that bump? What we've seen over and over again is that the over earnings in certain sectors does stabilize and go back to trend over time. There's been about $2.4 trillion extra in earnings since the pandemic started, and we suspect that has to come down to trend. So that's where we are. We are marginally more positive. We still have a neutral rating on equities. We never went underweight on equities because it's too hard to time the market. We do think that the market is expecting a Fed pivot in the near term. I can't see how that happens. Once they made the policy error of being too easy for too long, the chances of overcorrecting and staying tighter for longer go higher. And so the market's already rallied 10%. So what are you playing for at this point?
Alicia, I love you. That's just perfect. The kids going back to school, a celebration of life, getting back to normal. Lisa's face lit up as well. Alicia Levine of BNY Wealth Management. Go on, TK.
Afterthought the other day. She goes,
Isn't it a celebration of life returning back to normal, Tom? Sending them back.
I have to have a Norris pencil. Folks, Norris pencils are British pencils. They're absolutely gorgeous. Stadler's. John, did you use Norris
I've got no
pencils
idea.
in school?
I've
the
got
yellow
no
and
idea.
black ones?
I often forgot my pens and pencils, Tom. That was a problem.
They're expensive.
The celebration
And they lose them.
of life returning
Yeah, me
to normal.
going to school wasn't a celebration. It might have been for my parents. I'm not sure it was for the teachers. That's for sure. Futures up 0.8 on the S&P, on the Nasdaq 100 up 1.3%. Looking ahead to more earnings. At a Facebook later, Meta, and then on to Apple on Amazon tomorrow. This from the AC Milan fan club in Melbourne, Australia. We're waiting for you. Tom, we're waiting for you.
Road trip.
I am a member of the AC Milan fan club in Melbourne, Australia. Yeah,
really?
I'm a very bad member of the club because I haven't attended any meetings, but I'm a member. Futures up 8
It says
cents
after Davos.
on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Guerin. So Fed Chairman Jerome Powell is set to deliver the largest back-to-back rate hike since the 1980s today. And investors will be looking for signs that he's open to smaller moves starting in September. Policymakers are expected to raise rates by 75 basis points for a second straight meeting. Now, President Joe Biden will speak with China's Xi Jinping tomorrow. The call will take place at a difficult juncture for U.S.-China relations. House Speaker Nancy Pelosi's staff has not ruled out that she will visit Taiwan next month. China has warned against a trip. Beijing considers Taiwan part of its territory. For the second night in a row, the two Conservative candidates to succeed British Prime Minister Boris Johnson battled it out in a TV debate. Foreign Secretary Liz Truss and former Chancellor Rishi Sunak clashed again over the economy. Both accused each other of pursuing policies that are morally wrong. The debate was cut short when the presenter fainted. The debate organizer says she is now fine. It's a sign that Boeing's comeback is progressing. The jet maker increased deliveries of its highly profitable 737 MAX planes and sharply reversed its heavy use of cash. Still, Boeing's second quarter revenue and earnings were worse than estimated. And T-Mobile has raised its subscriber forecast for the second straight quarter. The wireless carrier blew past inflation-related setbacks suffered by rivals AT&T and Verizon. T-Mobile led competitors by adding 1.7 million monthly subscribers in the second quarter. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Guerin. This is Bloomberg.
Everyone's looking for another rate hike today.
Central banker is basically going to take a sledgehammer to inflation.
But will the Fed be able to steer clear of a recession?
We've got inflation, we've got a bit of a weakening labor market, and we have concerns about recession.
Trust Bloomberg for the fastest coverage and exclusive analysis.
This year's people that are calling for inflation peaked are last year's people that called inflation transitory.
Bloomberg Surveillance, the Fed decides. Today on Bloomberg, your global business authority.
80 is not even that extreme. 65 is where one model says it should go. But look, the market is a balancing act. Just one model output isn't actually going to be where euro goes. We're looking for 95 by the end of August. It could get to 90 cents if Germany doesn't build up enough gas storage.
What a call. Jordan Rochester there of G10 FX strategist over at Nomura from New York City this morning. Good morning. It is Fed Decision Day alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures positive 0.9%. A lift here on the Nasdaq by 1.4%. In the FX market, the euro showing some strength, 101.48, up 1/3%. And going into that Fed decision, yields lower by a couple of basis points to 278.49. I have to say on the commodity side of things, no sign of major damage, even with this headline out of China today, that Wuhan has locked down 1 million residents, Tom. That
it's still there.
Lockdown lockdown off in China has just not gone anywhere
it
for
ain't working.
2 years.
It ain't working, and you really wonder how it's going to fold in their domestic politics and, you know, the Pacific Rim recovery everybody's talking about. Seriously, Louis Vuitton today, LVMH, they were adamant of the hit they took in China.
Oh, I bet, Tom. I bet in a big way.
Yeah, they are. Futures up 1.4% on the NASDAQ with a very nice lift. The VIX, 24.33. We've been focused on Melbourne. Thank you to the viewers who corrected me that Perth is not off the Pacific Ocean on the ugly American. The Pacific Ocean's on the other side towards Melbourne and Sydney. Someone that knows this is Mr. Benenbrook. Nick Benenbrook is international economist at Wells Fargo, and without question in the foreign exchange racket is the most acclaimed for award-winning predicting in the toughest of toughest asset classes. Nick, I'm going to cut to the Benenbrook chase, which is you and Wells Fargo have global GDP 2023 1.6%. I have never seen that statistic.
Well, it has happened. I mean, we obviously had the pandemic and the global crisis. But yes, we are very negative right now in terms of our forecast. And there's two reasons. Number one, all of these very high prices are just chipping away at the consumer. And most of the major regions are already seeing negative income growth in real terms once you account for inflation. Plus, we think that many of these central banks, it's going to be tougher to squeeze inflation out. So high interest rates and declining real incomes are factors why we have that very negative
What does this mean for Jerome Powell in the fact that we were weaned, and L-Arian's on later today, he'll know this from years of academics, 3% is terrible global recession, and you're way below that. I mean, the 1.6%, folks, is a stunning statistic.
Well,
How does he react to it? He's central banker to the world.
I wouldn't say 3%. 3%'s okay. I would say 2%'s terrible global growth, and so we're in that terrible territory. How do they react? How they've reacted this year is, you know, when they've been faced with the hard choice between we've got to get inflation under control or we want to do something to help economic growth. For now, they're very much still steering towards higher interest rates and higher inflation. So I don't think they're going to pause. We still see a lot of rate hikes from the Federal Reserve.
Right now, we're also looking at the potential for both rate hikes from the ECB as well as the ongoing crimp from the higher gas prices and the questions around the supplies there. How come we are seeing the resilience of the euro after breaking through parity, especially considering the fact that many calls, including your own, have it going well with under that to 95?
Yeah, I think a couple of things are important there. Number one, the currencies are always a relative game. There's always two sides of the currency coin. And as tougher things are in Europe, as I mentioned, they're also tough here in the United States. With those nasty numbers that Tom was mentioning, we expect recession in both regions. So that helps to mitigate the extent of downside that we see in the euro. The other thing I would say is, for now at least, the European consumer, the household finances, they're one of the few countries or regions, at least, that has still got at least close to zero or slightly positive real income growth. So they're doing better than the US there, and high savings rates. So that'll help the consumer and growth for a while, but that can only last so long, those positive fundamentals. And so eventually we do think the Eurozone economy plus the Eurozone currency both go down.
What's the trigger for that?
I think the trigger for that is probably what we're seeing in terms of the squeeze, in terms of some of these energy prices. I mean, for sure, in the Eurozone, inflation's nowhere near as widespread. Right now, you've got core inflation at just under 4%, but the headline rate of inflation at 8.5% is all due to energy, and unfortunately, there's just doesn't look like any way those energy prices are going to come down, and so eventually that's going to be the trigger.
Link it back to your claim in foreign exchange. Explain how the dollar goes down or even stays level as a safe haven asset given this gloom.
Yeah, so I mean, there's a saying, what goes up eventually must come down, and partly that's to do with like the very sharp rise in interest rates that we see in the US going up to 4%, and then eventually basically coming down to 3% or 2%. So we do think that easing expectations are going to be much quicker from the United States. You make a good point, and maybe that's going to be an issue that prevents a massive slide in the dollar. But I do think financial markets being forward-looking types of animals or instruments, by the time we get to late 2023, we'll be less worried about the recession, as terrible as it will be, and we'll be starting to look forward to the hope of a better 2024. So as we get the combination of falling interest rates plus hopes of a better economy, that might be something that weighs on the dollar.
Benenbrook is out of 2024. I'm trying to figure out, back to school in
Trying
August.
to get to next week. Trying to get to next week. Nick, I wanted to fit this in. Are we still doing lockdowns in China in your world at the end of 23, looking at 24?
Well, my colleague Brendan McKenna is our Chinese expert, and we're certainly seeing, I would say probably lockdowns through end of 22 and into the early part of 23. But in terms of the conversations we're having, I suspect that by the time we get to mid to late 2023, China's sort of COVID policy has probably relaxed to a reasonable extent, and that we're looking at I think a more normal economic expansion by that
China's
period.
a hard call, that's for sure. Nick Benenbrook, thank you, of Wells Fargo.
Oh, yeah.
TK, you want to try and get out a couple of years. Try and do that with China. That's a tough call.
Well, yeah, China is as well, but I can't emphasize enough. I've never seen that statistic, John, to see 1.6% global growth. That completely reframes what the major central banks can do. Their, as Lagarde would say, their optionality or degrees of freedom is just completely constrained.
On and off, Tom, that economy's been locked down now for 2 years, and we're talking about a third year of it, basically.
Well, as you mentioned, Wuhan, I mean, I don't see any indication they're letting up, do you?
1 million residents? I don't see any indication of that whatsoever, Lisa.
Well, how much is the political pressure going to really get to them after a while, especially after the party Congress later this year? Going to the Regina Mayer point that she sees some of that normalizing later this year, which creates an issue. Then for the crude market, if all of a sudden that demand comes back online in a cold winter at a time when there's already strained capacity.
Speaker Pelosi, is she going to Taiwan? We'll see.
August, perhaps.
Anne-Marie's made this point a couple of times now. You've got to look at the domestic problems in China as to why perhaps they're making a much, much bigger fight out of this. I mean, it would always have been a fight and tension. I get all of that, but this just seems to get bigger and bigger by the day. Domestically here in America too. Futures up 0.9% on the S&P from New York. This is Bloomberg. A little bit of economic data coming out in America in the next couple of seconds. Mike McKee in position. He'll break that data for you going into it. Futures positive, 8 or 0.9% on the S&P, on the Nasdaq 100 up by 1.4% with that economic data. Let's get down to DC and catch up with Mike McKee. Hey, Mike.
Good morning, John. We've got some important numbers coming in that will bear on third quarter GDP. And so there are a lot of people paying close attention to what we are seeing this morning. The advanced trade good balance comes in at $98.2 billion. That's a significant decline from the 104 earlier. So that will count. That will be good news for the overall second quarter growth rate. Retail inventories up 2%. That's much higher than the 1.1% last time, and this may be one reason why Walmart and others have been complaining their inventories are too large. We're still stocking up. Durable goods orders just breaking, and this is a key for the Fed. What is business investment like? Durable goods orders up 1.9%, which doesn't tell you a whole lot because we're looking for the breakdown now in terms of capital goods, but I can tell you that capital goods shipments, non-defense, ex-air, this is the stuff that goes into GDP, up 0.7% after 0.8 the month before. The 0.7 is more than twice what was expected, so it suggests that business equipment that was shipped during the second quarter, in other words, counts on the books, was up significantly. So I think if you take the balance of the numbers that are out, and we just got the other durables numbers, ex-trans up up 0.3, and capital goods orders up 0.5%, which is the same as last month. So business is still spending, and it looks like all of these numbers this morning will contribute to second quarter GDP, will add to second quarter GDP. So maybe it pushes that recession tail a little bit farther out.
Well, that's where I wanted to go, Mike. I mean, it's going to be the first question to Chairman Powell today. How does the Fed interpret this data and maybe a positive statistic on GDP?
Well, they're going to be looking sort of beyond it because it's backward looking at this point. But what they want to see is consumer spending holding up. And we'll get that number on Friday. Unfortunately, they don't have it yet because they don't know what the services spending is like. And they want to see business investment remain strong. They can't do much about trade, although the trade deficit does come down. The strong dollar's a byproduct of their policies, so can't do much about that. And inventories, they can't do much about. What we're hearing from the retailers is they've got to clear that stuff out, which may be disinflationary if things go on sale. So things to keep in mind as we get the GDP numbers tomorrow that will be on the Fed's mind, even if they don't have the exact numbers yet.
Mike, excited for your Fed coverage. A little bit later, you'll be working with us, so we're looking forward to it. You'll be in the news conference too with Chairman Powell. You know what that means, Tom? Chairman Powell waits and waits and waits and tries to avoid the Mike McKee question for as long as he can.
They all go earlier. It's a scandal as well.
It's not on top.
It's an outrage. John, very importantly, 2-10 spread goes to greater inversion right now off this data. It's a new greater negative number, a wider inversion.
Yield's down about a basis point on a 10-year, Tom, 279.77.
Right. And right now, a joy, as we will speak to Dr. Dudley this afternoon, Dr. Larian, and other worthies on the Fed. We start strong with Edward Hyman. He is founder and chairman, head of economic research at Evercore ISI. He reports to Julian Emanuel on what earnings are doing. We're thrilled that Ed Hyman could join us this morning. Ed, your research note is classic Hyman today, and it is of things rolling over. And you hearken back to C.J. Lawrence when I read you like gospel. M2 is absolutely plunging. It seems out of another time and place. Explain the importance that M2, the monetary aggregate, is plunging straight down back near zero.
Well, the growth is plunging, but boy, Tom, you're right to pick up on this, and I'd like to keep on it. Last year, money growth was almost 30%. And that's, I think, why inflation picked up so much. You could put it different ways, like we had the stimulus checks and quantitative easing and the bottlenecks, but you could just go to a Milton Friedman cut at it. But now that's come way down. And that, I think, explains why inflation is slowing. So right now we have a race about 3 months before the funds rate will be over the bond yield, which would be a classic inverted yield curve. You already have the 210, as you mentioned, inverted. And so it looks to me as though the economy is doing fine now, but it's going to slow, and inflation is going to slow significantly. Actually, both are going to slow significantly.
There is a divide, Ed Hyman, between, let's say, Mohammed El-Arian and Bill Dudley and Lawrence Summers suggesting we need an aggressive Fed to get us anchored again in our price change, and others saying calm down. Ed Yardeni was on the other day, your former colleague at C.J. Lawrence, and Yardeni is everybody calm down, they're going to move and look at the data. If Powell moves after this meeting and he observes the data, what's he going to see in 6 months?
It's really 3 months that I'm focused on, but 6 months is okay too. I think the economy is going to look slower. Unemployment is going to be 4% or a little bit higher. But most importantly, inflation is coming in a lot slower than I've been expecting. Not the headline numbers yet, but commodity prices, for example, anecdotal is coming in. Every day I'm getting evidence that there is a slowdown. There's an article today that airfares are back below $300. So in 3 months, which is when the Fed is going to have the funds rate at 3%, I think that they'll be seeing quite a bit slower inflation. The issue is going to be for our shop or for Bill Dudley, is there enough progress to slow down the rate of increase in the funds rate?
Ed, have we already seen the shock in financial markets amid all of this gloominess, amid all of this negativity, as we've seen for this earnings season, that stocks have managed to rally even with not screamingly amazing returns and earnings?
Sure. First off, the Fed has gotten a lot of bang for their buck, one of which is that the drop in stock market has pushed down consumer net worth, which puts a drag on consumer spending. But there's a pretty good chance, like you're implying, I think correctly, Lisa, that this has already been discounted. I'm scared to go too far down that road because the Fed is going to tighten. And the question today is whether or not they give a little bit of room to tighten, to slow down the tightening in the next few meetings.
So what's the variable right now, Ed, that would mean that we have not yet seen the financial shock, that it hasn't been baked in? Because if people are looking at a slowdown in earnings, a slowdown in consumer spending, a Fed that tightens too much and then retraces, a lot of that has been priced in. That's what people say. And we get these results, they're okay, and people rally. At what point do we think maybe the narrative is different?
So I think in three months, we're on a track here that's going to end when funds get to 3, and we'll look around and see if there's a change. Now, the economy's been stronger, I think, than people realize. Earnings in the first quarter were up at about almost a 10% annual rate. And working with Julia and Emmanuel, like we mentioned, Tom, looks like they'll be up something close to 5% quarter-to-quarter annual rate in the second quarter.
Ed, your dressed attire is very good for the summer session here. I know you're wearing flip-flops this morning. For those of you on radio, behind Ed Hyman is a spectacular boat model, which looks like the Endeavor of 1934 to me. Ed, you're out in the Hamptons, and the bottom line, as you note in your research note, the Hamptons rental market is absolutely tanked. What does that symbolize to you?
I could go on about 25 examples like that, Tom. And I'm big on putting the dots together. And I think the tanking in the rental market in the Hamptons in August is just one sign that we need to take into account that the Fed tightening so far and the slowdown in the money supply and the increase in the mortgage rates and the decline in consumer net worth is all having an impact.
We can't complain when prices are up, Tom, and then complain when they're down. It's great news that rental prices in the Hamptons are down because, Tom, they were obscene. They have been obscene for so long.
Well, yeah, that's true.
Smallest violin in the world playing for you there,
Just for the
Ed.
record, I'm not in the Hamptons.
Thanks for clarifying,
John,
Ed.
you
could see Tom trying to wind you up there, I know.
Yeah, my metric, John, is a cup of coffee at Provision out in Sag Harbor, and it's just outrageous.
Ed Hyman of Evercore ISI. And Ed, we love the addition that is Julian Emmanuel to the team. Fantastic. We just heard from T-Mobile a little bit earlier this morning from the CFO. We saw a slight increase in bill payment delays. We heard this from AT&T.
Yeah.
Payment delays are up from 21, yet still below 2019. Customers are feeling the inflationary impact. They are, Tom. That's the story.
Yeah, and just as Ed's talking here, the 2-10 spread is out to 28 basis points inverted. That's extraordinary, John. I mean, when Priya Misra told us it had near 50 basis points, I almost laughed her out of the room.
We'll catch up with Priya later, Tom.
Wow.
Priya Misra from TD coming up on the Fed show, Lisa.
Oh, is she on the Fed show?
She is on the Fed show.
I did not know that.
I want to just sit on this T-Mobile headline that you were talking about, that they see that people are waiting a little bit longer to pay back their debts. And it goes to the conversation we've been having about credit card outstandings increasing as consumers lever up after eating down into their savings. How much do we see this coming kind of a pivotal point where you start to see leverage build up at a time when consumers don't have as much of an ability to pay it back, at least in the very near term, based on some of these indications? Again, the consumer's not that leveraged based on history, but it's something to watch on the margins as the story kind of enters a mid-cycle.
Reading the tea leaves. We'll do some of that in the next hour on Bloomberg TV. Bob Michael of JP Morgan is coming up alongside Krishna Mamani We'll catch up with him too. Morgan Stanley's Lisa Shallett and the Rio Tinto CEO will have an exclusive conversation with him.
Really?
In the next
They
hour
cut their
too.
dividend.
And then we can
They
follow
did.
up on that in Melbourne.
They did.
When we go.
I will see if
Ask
Jacob
him.
will have us, Tom.
Yeah,
I'll
ask him if Rio Tinto can attend in Melbourne.
I'll ask him in the next hour. We'll keep this theme going.
Superb.
And then later, the Fed decides. All-star lineup. Looking forward to this. I don't know where to begin and end, but Mohammed's on the list. Mohammed Al-Arian alongside Priya Misra, Michael Ferroli, Diane Swog. Take your pick. Bill Dudley, Jeff Rosenberg. There is only one place to watch reaction and the drumbeat to the Fed on Bloomberg TV and radio coming up later. It begins at 1:30 Eastern Time.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Bloomberg has learned that the Justice Department is using a grand jury to investigate efforts by former President Donald Trump and his aides to overturn the election. The focus is on creating fake electors and pressuring former Vice President Mike Pence to refuse to certify the Biden victory. No comment yet from the Trump camp. Bloomberg has learned that Senate Majority Leader Chuck Schumer has told donors he doesn't think there are enough votes in the Senate to pass a big anti-tech trust bill. The measure is designed to pare back the power of companies such as Apple, Amazon and Alphabet. Still, the bill's co-sponsors have maintained they do have enough votes for passage. In Europe, natural gas prices soared again after Russia tightened its grip on the region's energy supply. Benchmark natural gas surged as much as 14%. It's now more than 10 times higher than usual levels for this time of year. Supplies through Nord Stream, the biggest gas link from Russia to the European Union, fell to just 20% of capacity today. Gazprom says it is a maintenance issue. Shares of Spotify are rising. The music streaming service beat a range of analyst estimates in the second quarter. The company also said it would cut hiring growth. Plus, Spotify took a $31 million charge from its decision to quit an in-car hardware device. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
We look to see how revisions are unfolding in terms of forward earnings. And what we're seeing is a clear downward trajectory. We're not at the levels yet in these earnings revisions where we can say we've reached an all clear, where we've rolled everything in. There's more bad news on earnings to come.
Stephen Risciotto of Mizuho Americas, he was absolutely lights out yesterday and takes a more cautious view of what this Fed will do. And of course, they're on earnings as well. We welcome all of you on a Fed day. Just a terrific set of guests forward here over the coming hours. To Lisa, did John say 1:30?
Yeah, he said 1:30.
I didn't know that. I thought we started at 5 of 2.
Well, we'll talk to your crew, and we'll have your crew talk to their crew. And
Yeah, you know, that cuts out the 3-hour lunch today. So here's where we are. Futures up 34, Dow futures up 144. The Vixen nicely 24.32 with earnings out. We'll do that in a moment. Right now, Kriti Gupta, what do you have, Kriti?
Well, for the chart of the day, we're looking at the 40-day correlation between the S&P 500 and the dollar. Tom, this is a chart we go back to over and over and over again, but I think it's especially important in light of the Alphabet and Microsoft earnings we got last night. Now, of course, both beats, Microsoft putting an extra emphasis on the dollar. But what I really want to talk about here is that inverse correlation, which is now at -50. The idea here being about 50% of the time, you are going to see that inverse correlation. It is the strongest, or at levels going all the way back to 2011, 2012. Now, think about it. Back then, Europe was in crisis. It was really becoming a euro weakness, dollar strength kind of story, and it was post-GFC. So the question here is if you continue to see this dynamic, not necessarily as a result of the Federal Reserve's hawkishness, but more as a result of euro weakness, that's not going to bode well for the S&P 500.
Kriti, thank you so much. We're going to go all White, Fried, and Sandy here with Gina Martin-Adams, our chief equity strategist, to go inside baseball. Gina, can corporations hedge their foreign exchange headaches? My answer is it's difficult to do. It's not worth the effort. Can they?
Yeah, the short answer is no. I mean, I think in some cases you can have a stroke of brilliance in a hedging platform, but generally corporations really struggle with it and oftentimes go the opposite way. So they don't spend a tremendous amount of time on it. I think the other thing with currency is it's not only tremendously volatile at times, but also tremendously unpredictable. So attempting to do so oftentimes just doesn't work. And the market, frankly, doesn't reward it either. You might notice that the companies that have mentioned the currency impacts, the market is simply looking through those currency impacts, looking at the impact of longer term sort of core earnings. So it really isn't worth it, honestly.
Bron's what she just said, folks. She's 100% correct. It drives me nuts. Okay, Gina, you're too young to remember this, but I remember LIFO, FIFO. You studied it, you flunked it before you studied and flunked equipment leasing. What is LIFO, FIFO, and why is it suddenly a big deal to animals like you?
Yeah, well, it's a big deal because at points in the cycle where you have very big swings in inventory, it can have a pretty tremendous impact on bottom line. Whether or not a company declares their inventory as a first in, first out, once they sell the items that are first in, or they're selling the items that are last in, is really meaningful, particularly in points in time in which inflation is accelerating so rapidly. So this is, I think it's going to be a relatively large issue for most goods sellers over the next couple of quarters. We're already seeing it impact the retail space, where retailers are declaring that their inventories are too large. Certainly those inventories were purchased at relatively high prices by comparison to the prices that they're going to be able to charge for those inventories once they go out the door over the next couple of quarters. And that could be pretty meaningful. I think we're going to see this extend into semiconductors companies, for example, over the next several quarters as we start to get product back online. Will they be overrun with too much inventory in an environment of shrinking demand? So it is, LIFO, FIFO will make a difference.
Yeah.
Mostly it's about the inventory cycle and the fact that the inventory cycle is colliding with some pretty profound inflationary figures. But to the extent that it, company accounting can make a little bit of a difference, particularly in this kind of climate.
I mean, Lisa, we lost half the audience there. That was so boring. But Lisa, the way to remember this is Celine sweatshirts are very FIFO.
Thank you, Tom.
That's how you do it. I mean, just if anybody's watching is worried about Celine sweatshirts, they're first in, first out.
Gina, let's zoom out a little bit from Celine sweatshirts and just talk overall what we've seen from the earnings season, which has been, I guess, better than expected when it comes to the overall earnings. But the beats haven't been as big as they have been traditionally. Not as many companies have been beating. Is there a takeaway that amid all the gloom and all the negativity, at least economically, we have seen a bounce in so many of these stocks? Is there a technical reason to be more optimistic, as Alicia Levine was saying earlier?
Yeah, I think that the takeaway for us so far is that we priced in a tremendous amount of weakness. In particular, what we've seen is a big divergence in performance between the companies whose stocks are down more than 20% year to date coming into earnings and the companies whose stocks are down less than 20% year to date. The companies that have been beaten up more are very clearly bouncing. Whether they miss or they beat, the stocks are bouncing. So we had a pretty significant, obviously we priced in a tremendous amount of weakness and probably more weakness than is emerging. That said, you do still have the potential for surprise. It's mostly concentrated in the stocks that did not perform terribly poorly in the first half of the year. So Walmart is the poster child for this. Walmart didn't even report earnings, but merely guided in a pre-announcement that really shocked the market. The result of that was tremendous downdraft in the stock price. But remember, Walmart has held up very well so far this year. So it's a matter of expectations. Expectations were extremely low across the board, where expectations were still somewhat positive. We're probably in the stocks that hadn't underperformed materially. And those stocks are now experiencing a downdraft. But overall, companies still beating expectations at large, and that's created a little bit of a lift for stock prices.
Hugely valuable. Gina, thank you so much. And seriously, that accounting discussion was really quite good. This is new for so many different people. Lisa, Ian Lingen reports from BMO Capital Markets, always good in the bond market, and he doesn't mince words. He says the data that Michael McKee reported on is enough to give a lift to GDP.
Which is what Mike was referring to. But what does this do for the Fed? First of all, it comes after the Fed's report, so it doesn't mean anything for them. But what you can extrapolate out is that there still is enough resilience in the economy, at least in backward-looking data, for the Fed to go strong, to go big, to be bold, to go for the 75 basis points, and then indicate more to come.
The indicate's the key word here, because if I go 75-75, I think I'm almost in the vicinity of normal. I'll let other people tell me that. So today's 75, to be clear, Lisa, today's 75 is not a big lift, right?
It's not a big lift when it comes to the overall rate and whether we've actually normalized. We certainly haven't gotten to restrictive yet. But just to give you a sense of the scale and frankly how quickly things are moving, 2 back-to-back 75 basis point rate hikes is something that we have not seen since the Volcker era. We would have to go back to the 1980s to see the aggressive moves that we are likely going to see today, following on to the one at the last meeting.
It's not a measured time. That's all there is to it. I mean, the only thing that's measured is the stock market reaction once people calm down after the earnings come out.
Right now, it is as you say, a movable feast, right?
No, I'm going to call it a movable data check, and it's with a lift to it. SPX up 1%, Dow lagging a little bit, NASDAQ up 1.6%, Dow futures up 166. John Farrell points. Stay with us. This is Bloomberg.